This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 6 videos on trading ranges. I'll begin by distinguishing a pullback from a trading range. A pullback is simply a small trading range, and the trend is likely to resume. A trading range is a pullback that has grown to so many bars that it's not clear whether the trend will resume or reverse. Next, I'll talk about the 2 hallmarks of a trading range: confusion and disappointment. Whenever you look at a chart and you feel confused or disappointed about the follow-through after a move, you have to assume that the market's in a trading range, even if it does not yet look like it's in a trading range. Why did institutions create markets? The goal of the markets is to maximize trading. They want to make it easy to trade at a reasonable price. This is a 1-minute chart to illustrate a point. The market's going down and down more, but look what's happening to the volume as it's going down. As it's probing for a fair price, fewer and fewer trades are taking place. That means fewer traders are willing to sell at this low price. All markets are constantly in search of the best price, a fair price. And that usually means a price where trading volume will be maximum and the maximum number of trades will take place. So not just big volume, but big trades, lots of trades. And the market usually has to go too far to find out how far enough is. And then it tends to oscillate around the fair price. New information is constantly coming into the market, and eventually the market decides that the price is wrong and that it's either too high or too low, and it then has to probe in search of another fair price. I want to talk a little bit more about this volume. The market's falling, it's getting cheaper, yet fewer trades are taking place. If it's getting cheaper, bulls will want to buy more. The price is getting lower, and bulls always want to buy when the market is getting cheap. How can volume be going down if there are more and more bulls wanting to buy? It's going down because there has to be bears willing to sell for a trade to take place. If the trading is getting less and less and less as price is going down, that means bears are no longer willing to sell at that price. The price is too low, and the market has to go higher to find sellers. I want to be clear, I'm not recommending that you look at volume. I'm using volume here to illustrate a point. In fact, I think most traders should not look at volume. It's a distraction. However, it does illustrate a point. Trading was drying up, big volume, another big bear breakout, but fewer trades taking place. The market had to go higher to find traders willing to sell. Remember the goal of every market. It's to find an area of agreement between buyers and sellers, between bulls and bears. And that's the reason why most bars on charts are in trading ranges or channels which become trading ranges. Only about 5 to 10% of the bars on any chart are in a strong breakout. 90% of the bars on every chart are either in a channel, which evolves into a trading range and is the beginning of a trading range, or in a trading range. That's because the market perceives a trading range as a range where price is most fair. And since the purpose of markets is to find an area of agreement between bulls and bears, price tends to oscillate around a fair price. In this particular example, you can see most of the bars are within a trading range. As I said, on any chart, only about 5 to 10% of the bars are clearly in a breakout. Only 5 to 10% of the time does the market clearly believe the price is wrong, and the market quickly finds a more fair price, a trading range. Here is a strong bull trend, but even when the market's in a strong bull trend, there are periods of two-sided trading. As bulls see the market go higher and higher, their stop is still down here or down here. It's becoming further and further away. That means their risk is greater, and at some point they have to reduce that risk. The easiest way to do it is to take profits. And that's what happens here. You start to get pullbacks when the bulls are concerned that their risk is too great and maybe there's not that much left to the upside. They reduce their position sizes. Obvious stop at the bottom of the bull breakout or below the bottom of the entire bull trend. And that profit taking creates pauses in the trend. Eventually the pullbacks get deeper and deeper and deeper as bulls become less willing to buy high. They'll only buy deeper pullbacks, believing that the market is evolving into a trading range. The more it becomes a trading range, the more bulls only want to buy low. Every pullback is a trading range, but a small trading range. As long as traders believe the trend is probably going to resume, I use the term pullback. If the pullback grows to 10, 20, 30 bars, then the trend becomes further and further to the left. It has less influence on the market, and eventually the direction of the breakout becomes unclear. It becomes equally likely that the breakout will be to the upside as it is that it will be to the downside. At that point, I use the term trading range. Pullback when you think the trend will resume, trading range when it's no longer clear. Any area of two-sided trading is a trading range, even if it's only a single bar. It's common to see pauses in trends that last only one bar. For example, here, the market went up strongly and then it hesitated. On a smaller time frame chart, this is a trading range if you get to a smaller time frame chart. For example, if this is a daily chart, on a 5-minute chart, this is probably a trading range day. It's a pullback on this chart, but it's a trading range on a smaller time frame chart. Remember, I think of every pullback as a small trading range, but a special type of trading range in which the trend is likely to continue. I only use the term trading range when I believe the bulls and bears have become balanced. For example, a little pullback after 3 bull bars, probably going higher. 3 bear bars, but about a 50% pullback of this rally, the trend probably will continue. Here, more bars in the pullback, it's less certain that the trend will continue. Strong bull trend, a pullback, still more likely to go up. But we have a bear breakout below the bull flag, and the bulls are giving up here. And bear trends usually begin with bear breakouts. And we got a spike and then pullback, double top bear flag, and a channel down. Bull trend over here, bull breakout, pause, the trend resumed. Does this look strong enough to make traders believe the market will reverse this bull breakout? No, I would call it a pullback in this breakout because I believe the odds are the market's going higher. The same with right here, probably going at least a little higher. Same thing in a bear trend. Maybe this is a bear trend, maybe it's a bear leg in a trading range. I think this does not look strong enough to reverse that, so the bears are hoping this is a bear flag. It turned out to be. Strong bear breakout, good follow through, trying to reverse up, not looking good for the bulls. This is a small pullback. It grew into a larger pullback. Is it a trading range yet? I would not use the term at that point. I still think the odds are the bears are more likely to get a bear breakout, so I would still call this a pullback. Double top bear flag, first high, second high. Same with here, probably going lower. Here, it's probably going lower, becoming less likely. Maybe you can start calling it a small trading range. Very strong bull breakout and good follow through. We have some bear bars here. It's a 10-bar trading range. However, do you think it's more likely that the bull trend will resume or more likely that it will reverse into a bear trend? Most traders would look at this and say, it's still more likely to go higher. And therefore, I would use the term pullback rather than trading range. You can call it a trading range. It is a trading range. Every pullback is a trading range. But as long as I believe the trend is going to resume, I usually use the term pullback. Strong bear trend, pullback, probably going to resume down, even though this pullback has about 15 or 20 bars. The bulls have not done enough to create a major reversal, and therefore the odds still slightly favor the bear breakout. You could say the trading range lasted all the way to here, so more than 20 bars, getting close to 50-50 chance the bulls will get a reversal. However, I still believe the odds are more likely that the bears will get the bear breakout. Even when a pullback goes 20 or 30 bars, I still think the odds slightly favor the trend that preceded it. Here we have a pullback that grew to 20 or 30 bars. It's close to 50-50, probably a little bit higher for the bears, maybe 51 or 52%. The trend will resume down, maybe 48, 49%, it will reverse up. Now we have another pullback, still a bear trend, pullback more than 20 bars. At this point, I would start using the term trading range. We have a potential final bear flag here, breakout, pretty good rally here, a lot of bull bars here. This is probably neutral at this point. 50-50 chance the bears will get another leg down, 50-50 chance the bulls will get a major trend reversal. Here, a higher low major trend reversal. Bear trend, bull breakout, couple legs down, good looking buy signal bar, higher low major trend reversal. Remember, the more bars that get added to the trading range, the more distant the bear trend becomes, the less influence it has on the direction of the breakout. And at some point, after 20, 30, 40 bars, the probability for the bull breakout, the reversal, becomes almost as high as the probability for a resumption of the bear trend. Bear breakout, 4 consecutive bear bars, but look at the bodies. 1, 2, 3, 4. They're getting smaller, and here it became a doji. Bear breakout here, followed by a strong bull reversal. The bears are losing control, and it's clearly neutral, not yet bullish until you see these 2 or 3 bull bars. Big up, big down, big confusion usually results in a trading range. And once a pullback grows to 20, 30, 40, 50, 60 bars, it's becoming increasingly balanced. And the prior bull and bear trend, in this particular case, there's a bull trend and a bear trend. At this point, they're so far to the left that they've lost influence. And the market is a 50-50 market, 50% chance bull breakout, 50% chance bear breakout. If one side clearly had higher probability, the market would not be doing this. For example, if everyone looked at this and thought the probability was the market would go higher, it would be going higher. If they thought the market was going to go lower, it would be going lower. The only way it can stay like this is because traders cannot determine whether it's more likely to break to the upside or to the downside. Two important hallmarks of a trading range are confusion and disappointment. And if you feel either, the market probably is in a trading range, even if it's not obvious at the moment. Trading ranges can be very difficult to trade. There's always confusion at the start of the legs. It's rarely certain that a reversal has begun. So, for example, is this going to go up far enough for a trade? What about this? What about this? What about this? Signal bars and setups are usually weak. The trends are weak. They reverse. The pullbacks from the trends are often deep. Bull trend, but big reversal to a higher low. It's a pullback, but it's very deep. Usually, when you have a trend with a very deep pullback, in this case, up and then down, down, big confusion, usually leads to a trading range. Here we have big down and big up, usually leads to a trading range. Signal bars are often weak. You want to be buying after 5 consecutive bear bars, one of them closing on its high. Here you have a doji bar, does not look like a strong buy signal. Here you get a bull bar, but following a very big bear bar with a follow-through bar, not a convincing buy. And you want to be selling this after 3 strong bull bars. Here you got a high 2, high 1, high 2, but a bear bar. Do you buy this? Well, what about this? It fell below that low. Also, trading ranges tend to spend a lot of time in the middle. Here, we're spending a lot of bars in the middle of this range. We get a breakout to a new low, and then this whole thing becomes a bigger range. And then look at this, we're spending a lot of time in the middle third. Bad follow through after strong trend bars and breakouts. Good bull bars, bad follow through. Good bull bars, bad follow through. Strong bear bar, bad follow through. Good bull breakout bars, bad follow through. That's very common. You're constantly disappointed and confused. Every time the market looks like it's about to break out, it reverses. Setups that look like they should be low probability, in fact, are closer to 50% probability. Things that look bad are not as bad. This looks like a low probability buy, yet it did that. This is not a particularly high probability buy, neither is this. But bulls buying above the high of those signal bars still were able to make scalps. On the other hand, setups that look like they should have high probability, 60% probability, also have closer to 50% probability. Rather than a normal breakout or channel market where probability is usually often 40% or 60% low probability or high probability, in a trading range, probabilities tend to gravitate to around 50-50. Nothing is as bad as it looks, and nothing is as good as it looks. Looks like a bad buy, yet went up. Does not look like a very good sell, yet went down. Looks like a strong bull breakout, but look what followed. So it was not a high probability that the market was going to continue higher. Disappointment. Just when you think the market looks like it's about to break out, you get a reversal. Strong bear breakout, it reverses up. Even stronger bull breakout to a new high, it reverses down. Bad follow through, constant disappointment. If you see that, you know that you're in a trading range. Second leg traps, first leg up, pullback, second leg, and instead of this leading to a breakout, it led to a reversal. The market often looks strongest right before it reverses. Here's a small second leg trap, 1, pullback 2, and instead of continuing up, it reversed down. Here, small second leg trap, leg 1, pullback 2, instead of continuing down, it reversed up. And then a large second leg trap, 1, pullback 2. Gaps and negative gaps, they usually close. The bulls have a little negative gap here, should go up and eventually close. It soon closed. Bulls trying to get a gap here, and it closed. Bulls trying to get a gap here, breakout test, strong bull breakout, testing this high, it closed. Bears have a bear breakout here, the gap closed. Bulls get a breakout here, gap between this high and all of these lows, and eventually it closed. So disappointment, gaps closing all the time, bad follow through after strong breakouts up and down. In a trading range, my 80% rule, 80% of breakout attempts fail, no matter how strong they look. Very strong reversal up and good follow through. Odds are buyers below, but at some point you have to conclude there are not enough buyers below to get a second leg up after this strong bull breakout. Strong bear breakout, and what happens? The market reverses. And bulls trying to break to the upside again here and here, reverses. Bears trying to get a breakout here and again here, it reverses. 4 consecutive bear bars, reverses up. Like all markets, trading ranges resist change. Trends, they resist reversing. 80% of the reversal attempts in a trend fail and become flags, and the trend continues. In a trading range, 80% of the breakout attempts, the market trying to become a trading range, those breakout attempts fail, and the trading range continues. Traders are constantly disappointed by follow-through. Very strong pair of bull bars, And look at this. If you're a bull and you bought that close, what are you thinking? You're disappointed. If you're a bear, thinking that this might be a measuring gap, and then you see the follow-through bar, disappointment. When you see that, when you see bad follow-through after strong trend bars, you're disappointed. That is the second hallmark of a trading range. The first one is confusion. Strong breakout, bad follow-through. Strong bear breakout, bad follow-through. Strong bull bar, bad follow-through. Strong bull bar, bad follow-through. Strong bull bar, bad follow-through. When you see what appears to be a bull trend, yet the bull bars have bad follow-through, the bull trend is probably a bull leg and what will end up as a trading range. Here we're trying to continue up, but look at the follow-through. Where are the consecutive big bull trend bars? We had some early on, but not here. Here we had bad follow-through after every strong breakout. Here we don't even have breakouts. This is probably a bull channel that will become a trading range. Strong breakouts up and down, but the gaps soon close. This closed below the low of that bar and below the low of these bars. But look what happened. It closed. Strong breakout far below the low of that bar. The close is far below that bar. Gaps with all of these lows. Yet, look what happened in the next few bars. Every one of the gaps closed. Strong breakouts creating gaps, but the gaps close. Pullbacks usually go below breakout points. For example, here we have a breakout, but look at the pullback. It fell below the breakout point. Here, a strong bear breakout. And what happened? The pullback came back above the breakout point. Bull breakout quickly came back below the breakout point and even reversed down. Another sign of a trading range. Possibly an early bear swing. But because of all the trading range price action, traders will assume that this bear breakout will pull back above the breakout point, which it did. We have a bull swing and an attempt at a bear reversal, but it turns out it was just a deep pullback from this rally. Pullbacks are deep, so the market makes a big move up, gets a deep pullback down. Market makes a big move down, gets a deep pullback up. Again, the bear is trying to turn the market down, but look at the size of this pullback. It retraced most of that bear breakout. Every trend is really simply a leg within the trading range and not a trend. Bull trend, yes, but really a bull leg in a trading range. Bear trend, yes, but really simply a bear leg in the trading range. Remember, any pause in a trend and you look at it and you believe the trend will continue, that pause is a pullback. It's a small trading range. Again, I use the word trading range if the pullback has grown to so many bars that it's unclear whether the trend will continue or reverse. Here we have a pause, a pair of inside bars, an II pattern. This bar is inside that bar, and this bar is inside that bar. Its high is at or below that high. Its low is at or above that low. Bull trend, a pullback. It's some profit taking by the bulls. It's also an attempt by the bears to reverse the trend. When you look at this pullback, you say, wow, those bears are so strong, this reversal is going to succeed. Or do you look at that and say, wow, that's not much by the bears. Chances are the trend is going to resume. Obviously, the trend is likely to resume, and therefore this small trading range is a pullback. It's a bull flag. You're confident that the trend will resume. The odds are very high that it will continue at least a little bit higher. On the other hand, if you see a pullback and you're not really certain whether the trend will resume or reverse, I use the term trading range instead of pullback. For example, at this point, do you think the bull trend will resume? Or do you think this might be a higher high major trend reversal and the start of a bear trend? You don't know. It's pretty much 50-50. At that point, I would start using the term trading range. And I look to the left to determine where the range began. Maybe it began here. Maybe it began here. Remember, every channel is usually the beginning of a trading range, even though it's still part of the trend. Trends transition. You have a strong bull breakout and then a channel. The channel is usually a transition into a trading range. So it's part of the bull trend, but it's also part of the trading range. Trading range on the 5-minute chart here, the bulls and bears are balanced. The bulls try to get head and shoulders bottom, left shoulder, head, right shoulder. Breakout, but not all that far. And the bears see a double top bear flag, and the bears won. If you look at the 60-minute chart, all of this is simply a pullback on the 60-minute chart in a strong bear trend. So on the 60-minute chart, this reversal attempt is probably going to fail, and the bear trend will probably resume down. On the 5-minute chart, that's not the case. It looks pretty balanced, bulls and bears. At this point, a swing up is probably equally likely as a swing down if you're looking at the 5-minute chart. However, this bull swing, even though the market's always in long on the 5-minute chart, it's simply a pullback on the 60-minute chart. The bear trend on the 60-minute chart is therefore likely to resume. Here's a 5-minute chart of the euro versus the dollar, and you have a bull trend and then a trading range lasting maybe 30 or 40 bars. Initially, the odds favor the bulls, but every bar that gets added to the range makes the probability closer and closer to 50-50. The bears see a head and shoulders top, left shoulder, head, right shoulder. The bulls see a nested wedge bull flag, 1, 2, 3, or 1, 2, or 3. If you look at a 60-minute chart of the same thing, this 2 hours of sideways to down trading is simply a pullback on the 60-minute chart. When you look at the 60-minute chart, this does not look like it's strong enough to reverse this 4 big bull bars. On the 60-minute chart, this 2 hours of sideways to down trading is a bull flag. On the 5-minute chart, it's not as clear, and the probability is almost as high that the bears will succeed as it is that the bulls will get their trend resumption. In general, it's better just to trade one chart. If you're a day trader, you're probably trading the 5-minute chart and you're not worried about the 60-minute chart. You trade the pattern in front of you. 60-minute chart, clearly the odds are the market will resume up. But if you're day trading on the 5-minute chart, a lot of times a bull flag on the 60-minute chart, bears can make money selling on the 5-minute chart. Those swings are often big enough down so that the bears can make money on the 5-minute chart. Small trading range, the market probably resuming up. I would call it a pullback. Even this, probably resuming up, so I would call this small trading range a pullback as well. When that's the case, when you believe the market is going to continue up, it's usually better only to trade in the direction of the trend. In this case, buy. On the other hand, this pullback grew to 30 or 40 bars, and it's not as clear if the trend will resume or reverse. And this range is very tight. Traders probably are better off not trading. Here, we have a pullback. Is it a reversal? I don't know. We went to a new high. It's confusing. Big up, big down, probable trading range. Big down, big up, probable trading range. And you could say this whole thing is a trading range. Once it becomes unclear whether the trend is going to resume or reverse, traders stop using the term pullback and instead refer to the pattern as a trading range. In a trading range, there are always reasonable buy and sell setups. The bears see a lower high major trend reversal, the bulls see a double bottom bull flag. The bears see maybe a wedge, 1, 2, 3, or a double top, and the bulls see a double bottom, or a double bottom here. A bull trend needs higher lows and higher highs. And bulls look to put their stops below major higher lows. Is this a major higher low? Well, I like to see two things. I like to see a strong breakout and preferably to a new high. So this is not clearly a major lower high. This falling below that is not enough to make me conclude the bull trend has ended. However, this is a strong bull breakout to a new high. If the market falls below this, it's probably no longer a bull trend. This did not fall below that, so you could argue this is still part of a broad bull channel forming higher highs and higher lows. Here we have another very strong bull breakout to a new high, so this then becomes the major higher low. If the market falls below this, then traders will conclude the bull trend has ended and the market has either become a bear trend or a trading range. And it did fall below that low at this point. A major higher low, another major higher low. Finally, the bears broke below major higher lows. That ends the bull trend. At this point, no more bull trend. It's either a trading range or a bear trend. We fell below this low, but this is a minor higher low, and therefore falling below it does not change the opinion of the bulls. They still believe the bull trend is up and it's just having a deeper pullback. Where is the major higher low for these bulls? Well, it's probably down here or down here. These bulls are still bullish as long as it stays above this low or that low. Obviously, if it breaks strongly to the downside and does not reach those lows, the bulls will conclude the bull trend has ended. But if it simply kind of drifts down but stays above the major higher lows, it's still a bull trend. Here we have a bull trend, a second leg up, and we're starting to get small bars, a lot of small bars, and the pullback just seems to be endless. When that happens, the prior bull trend loses influence. The further the bull trend gets to the left, the less effect it has on the market. The breakout becomes equally likely in either direction. Again, the bulls see a double bottom bull flag, and the bears see head and shoulders top or a wedge top, and then a lower high major trend reversal. Whenever you look at a chart and you see a good argument for the bulls and for the bears, you know you're in a trading range. I stop using the term pullback and I start to say trading range. Equally likely that you'll get a bull breakout as it is that you'll get a bear breakout. What's the minimum for a trading range? Usually 3 legs and 20 bars. We have a leg down. It's still a pullback in a bull trend. It's still above this major higher low. Then we have a leg up, a resumption of the bull trend, a bull channel, higher lows, higher highs. And as soon as you see the third leg down, and if it falls below a major higher low, this barely did, then you have to be thinking that we have the minimum ingredients for a trading range. 3 legs, 1, 2, 3, and we fell below the bottom of a major higher low. This is probably a more important higher low. I mean, it clearly is a more important higher low, but this, I think, is increasing the likelihood that the market is in a trading range. I would conclude that it's in a trading range at this point. The bears need a lot of bars to create doubt in the minds of the bulls. And once they do have enough bars, 3 bear bars, 4 bars here, 3 here, and then about 8 or 10 consecutive bear bars here. Once the bears have created enough doubt in the minds of the bulls about the continuation of the bull trend, the market's in a trading range. And there's equal chance that the bull trend will resume up as there is that it will reverse down. Equally good reasons to buy and sell. Remember, a trading range always has to have both buy and sell setups. They have to be equally good so that you're not sure if the bulls or bears will win. In other words, it's confusing, and confusion is one of the hallmarks of a trading range. Bad follow-through after each leg. A strong bull leg, bad follow-through. And strong bear leg, bad follow-through for the bears. As the range grows, new buy and sell setups form. Old ones don't work and they evolve into new ones. I began this video by distinguishing a pullback from a trading range. A pullback is a small trading range in which the trend probably will continue. Once the pullback adds enough bars so that it's unclear whether the trend will continue or reverse, I use the term trading range. If ever you look at any chart and you're confused about what's going on, or you're disappointed after a strong move up or down, you have to assume that the market is in a trading range. And if it is, you trade it like a trading range. You buy low, you sell high, you scalp. I'm Al Brooks. This is the first of 6 videos on trading ranges. Thank you for watching the Brooks Trading course. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 6 videos on trading ranges. I'll begin by talking about how every trading range always contains both buy and sell setups, and the setups are reasonable. I'll move on and talk about breakout mode. The trading range has a 50% chance in general of a bull breakout and a 50% chance of a bear breakout. And finally, I'll talk about second leg traps. Trading ranges are always trying to break out into a trend. There's often a first leg that's not particularly strong, and then a pullback, and then a very strong second leg, and it looks like the start of a trend. However, it very often is a trap, and I refer to that as a second leg trap. And those traps usually reverse and go to the opposite side of the trading range. Take a look at this chart. Clearly in a trading range, you could say the trading range began over here, but let's just use this part of it right here to illustrate a point. Every trading range, always 100% of the time, has both a reasonable buy setup and a reasonable sell setup. And whenever you look at a chart and there's both a reasonable reason to buy and a reasonable reason to sell, you know the market's in a trading range. My 80% rule, 80% of the time, the trading range breakout attempts will fail and the trading range will continue. We tried to reverse down, we tried to break to the upside, we tried to reverse down from a double top or a higher high. We tried to break to the upside, tried to break to the downside, tried to go up to the upside again. Finally, it appears that the market might be breaking to the downside. 80% of breakout attempts, no matter how strong they look, will fail when the market's in a trading range. We have a bull trend and then a trading range, and every trading range in a bull trend has both a double bottom of some kind, and the bulls hope that the double bottom bull flag will result in a bull breakout and a resumption of the bull trend. And every trading range has some kind of a major trend reversal. Here we have a lower high major trend reversal, and it's also a head and shoulders top, left shoulder, head, right shoulder. Here's a trading range in a bear trend. And every trading range, whether it's in a bull trend or a bear trend, will have both a reasonable sell setup and a reasonable buy setup. We have a double top bear flag, a slightly higher high double top bear flag, and then a smaller double top for the second of the two tops, but basically a double top bear flag. And the bulls see a double bottom, higher low, major trend reversal. Bear trend, bull breakout, higher low, not enough bars for a major reversal, so we got a minor reversal. Now we have a double bottom and plenty of bars for a major reversal, so a double bottom, higher low, major trend reversal. 50% chance there will be a successful bull breakout and a reversal of the bear trend. 50% chance there'll be a successful bear breakout and a resumption of the bear trend. I say that, but unless the setup is especially strong, I think the prior trend still has a slightly higher probability of resumption than reversal. Another feature of trading ranges is the top and bottom are never all that clear. Every trading range eventually breaks out into a trend, and there's about a 50% chance of a bull breakout and a 50% chance of a bear breakout. In addition, there's a 50% chance that the first breakout attempt will fail. It'll reverse. Again, my 80% rule, 80% of breakout attempts will fail. The market has inertia, and it continues to do what it has been doing for a long, long time. Because 80% of the breakout attempts up or down fail, traders look to buy low, sell high, and scalp. You scalp because you assume the market is not going to break out. 80% of the breakout attempts fail, so you have a better chance to make money by taking quick profits. Beginners are naturally hopeful that a strong move near the bottom will result in a bear trend, a strong rally at the top will result in a bull trend, and they end up buying high. They see strong bars near the top. Here we have 5 bars without a bear body, and they think that because we've broken above all the bars to the left, this is the start of a bull trend. And here they now see 7 consecutive bull bars, and they think, wow, this is really gaining strength. It's going to become a bull trend, and they end up buying at the top. And at the bottom, they'll see 5 or 6 consecutive bear bars, and then another breakout with a follow-through bar, and they assume that the bear trend will be successful. But with all the trading range price action to the left, the odds are all of these breakout attempts will fail. Beginners end up buying at the top and selling at the bottom, which is the exact opposite of what the experts are doing. A lot of traders have a good sense of where the approximate top and bottom of the range is, and they're confident enough that the breakout attempts will fail, so that they begin to buy as the market is in the buy zone near the bottom, and they begin to sell when the market is near the top in the sell zone. They use wide stops and they scale in, confident that the breakout attempts will fail and the market will reverse and they'll make a profit. Again, experienced traders are confident that no matter how strong a breakout looks, it's going to fail and the market will reverse. Another strong breakout attempt, reverse. Strong bull breakout attempts at the top, and they reverse down. Because traders know that the breakouts are unlikely, they're also going to be taking quick profits. They tend to scalp when the market's in a trading range. For example, a lot of trading range price action here. We're trying to get a bull breakout, maybe strong enough for a second leg down. Maybe this is the end of the second leg. Maybe we get a double bottom. Some bulls will buy here, use a wide stop, and look to scale in lower. Another breakout below this double bottom. The bulls are confident it will not get very far. Some bulls will buy more above this good-looking bull bar. Other bulls will hold on to their original position. If the second entry is less than a scalp distance away from this entry, a lot of traders will not add to their position. On the other hand, if the second entry is bigger than the size of a scalp, a lot of them will add on, and then they'll get out, break even on their first entry or on the entire trade. Others will take the second entry and just hold and look for some kind of top in the top half of the trading range, and then they'll exit. When you're in the top half, top third of the trading range, traders begin to look for reasons to sell. A break above this high probably will fail, probably will not get far. Some bears will sell here. Others will wait for a strong bear bar and then sell below the low. Here it's a second entry short. Down, this bar fell below that bar. triggering a first entry short. You can argue a wedge, 1, 2, 3, or 1, 2, 3. With 4 or 5 bull bars up here, a lot of traders would prefer a second entry short and to sell below a bear bar, so they might sell here. And their stop might be here. They might use a wider stop to allow for the possibility of one more minor high before they get a swing down. A lot of traders, when the market's in a trading range, expect every breakout attempt to come back above the breakout point. They'll place a buy limit order to buy at that low, and they'll get filled here. And then they'll place additional limit orders to buy lower. In general, it's better to take a second entry if it's at least the size of a scalp below. And then if the market gets back to your original entry price, you make a scalp profit on your second price, and you can get out, break even on your first. Or if the context is good, you might try to get a scalp on your first entry as well. Again, new low. A lot of bulls will place a buy limit order to buy at the most recent low, so they'll buy here. And if it falls for the size of a scalp or 2 times the size of a scalp, they'll buy more lower. Others will wait for the reversal up and buy above this bull reversal bar. These are examples of limit order buys at prior lows, and here's a scale in. Traders use wide stops, confident that the bear breakouts will not result in a bear trend and that they'll reverse fairly soon. The bottoms are rarely ever clear. However, traders have a good sense of approximately where the market will reverse. They know this is a reasonable buy zone, a bottom third of the screen, and they know this is a reasonable sell zone. So traders will start selling either below bars here, here, a second entry short here, or above bars at this high, and then sell more higher. As I said, many traders will buy more lower if the second entry is at least the size of a scalp below the first entry. And the same at the top. They'll sell at a prior high, sell at a prior high, and they'll add on. A lot of traders will add on. Some traders will add on 2 or 3 times and use a wide stop, confident that the bull breakout will fail and that the market will come down to their original entry price, and they'll be able to get out, break even on their first entry and with a profit on their later entries. Again, you can scale in. If you do scale in, you have to trade small enough so that the total dollars you stand to lose if your stop is hit are no more than what you would lose on any other trade. And as I said, whenever you scale in, it's usually better to only scale in if the second entry is at least the size of a minimum scalp. I'm going to talk now about breakout mode. In other words, the market is sideways in a trading range, and traders are expecting a breakout. Remember my 80% rule. 80% of trading range breakouts fail, except when the market is in breakout mode. If there's a reason to expect a breakout to occur fairly soon, the probability of a successful breakout is higher. We have a triangle, a series of lower highs and higher lows. So we have a bear trend and a bull trend, and we're getting near the apex of the triangle. I said before, 50% of breakout attempts when you're in breakout mode fail, and we tried to get a bear breakout, and then we reversed up. I also said 50% of the time when the market's in breakout mode, the breakout will be a bear breakout, the ultimate successful breakout will be a bear breakout, and 50% of the time, the ultimate successful breakout will be a bull breakout. Here we had a failed bear breakout, happens half the time that the initial breakout fails, and then we ultimately had a successful bull breakout. Lower highs, bear trend, higher lows, bull trend, and the result is a triangle. Again, probability of a failed breakout and a reversal from that breakout, 50%. The probability of a successful breakout is 50%. We have a triangle, 50% chance the ultimate breakout will be up, 50% chance it'll be down, 50% chance the first breakout will fail. Here, the bears tried to reverse the first breakout, but they were unsuccessful, and this first breakout ultimately did succeed. Another trading range, 50% chance of a reversal before reaching a profit target, We had a failed bear breakout, and then we had a failed bull breakout. The bulls see this as a high 2, a double bottom bull flag. The bears see this as a higher high, major trend reversal. Bull trend here, break below the bull trend line by going sideways. An attempt to resume the bull trend that failed and formed a higher high, major trend reversal. I want to talk some about second leg traps. I think they're very important and they create a major problem for traders starting out. Here we have a bull channel, maybe a wedge, 1, 2, 3. Complex first leg up. The bears tried to reverse down, but then look what happened. 4 bull bars closing well above their midpoints. 2 of them are very big bars closing at their highs. It looks like this will result in a second leg up. So the first reversal down, bulls probably will buy and will then resume up. I say that without showing the bars on the left. If this is still part of a big trading range, or if it's a part of a big broad bear channel, then the odds of this being a successful breakout are much less. Traders want to see what the follow-through looks like. We're getting a bull breakout above a bull channel, and you know that 75% of the time, if you have a bull breakout of a bull channel, it's going to reverse down within about 5 bars. In fact, if you have a bull or a bear breakout of a bull channel, it'll reverse within about 5 bars. For example, I could draw a line along the bottom, and we have a bear breakout below that channel, and then we reversed up. If this exact breakout was occurring out of a trading range, the odds would be 60% chance we would get a measured move up. But because it's a bull breakout of a bull channel, 75% chance it's going to fail. Remember the market cycle. A trend starts with a breakout, moves on to a channel, and then to a trading range. That's what happens 75% of the time. Only 25% of the time do you get a bull breakout, a bull channel, and then another bull breakout, starting the market cycle over again. So bull breakout, pullback, and then another channel before the trading range begins. Because this is a bull breakout of a bull channel and not a bull breakout of a trading range, 75% chance it's going to fail within about 5 bars. As I said, this is a tight channel. You can call it a complex first leg up, a wedge top. The bears tried to reverse and failed, and now the bulls are again trying, so this is a second leg up. And look what followed. Strong bull breakout, terrible follow through, probably buyers below. Bulls will probably buy the first reversal down, and they did, but not for a swing. They were scalping out. The bulls who bought this close, disappointed by this. A lot of them bought more, maybe a scalp below, and tried to get out break even at their original entry. And now we have a micro double top and a second failed breakout above the top of the channel. Here's the first failed breakout above the top of the channel, and this is the second one. Most bulls would get out below this bar, and the result is a give up bar here or here, and bears will sell below this bar. Not many bears will sell here after this much strength. Once the breakout fails a second time, a lot of bears will start selling, and this is an example of a second leg trap. Strong second leg, beginners see the 4 bull bars, and they believe the market cycle is starting over, and that it's going to lead to a measured move up and a swing up. But they're overlooking the reality that this is a bull breakout above a bull channel. And 75% of the time, you're going to get this, a reversal down to the bottom of the channel. Complex two-legged rally. The first leg was a wedge, and then a reversal attempt, and now another breakout, and then a second reversal attempt. You can also call it a complex top if you want. We tried to top out here, it failed. We tried to resume up, and that failed. This then is the second top. The wedge top is the first. This micro double top is the second. Bulls disappointed by this bear bar. They get out break even here or here, and the bulls that did not give up here. A second entry for a failed breakout of anything is a higher probability trade. And this is a second entry for a failed breakout above a bull channel. And it has a good sell signal bar. and it follows a first entry that also had a good sell signal bar. So this is a higher probability sell. Big up, big down, so big confusion. Big confusion usually means the market's going to go sideways, and it went sideways for about 10 bars. Reasonably strong bear breakout. Probably sellers above, probably the first reversal up, bears will sell it, and then a second leg down. But sometimes the second leg is brief, only a single bar. For example, after this big bull breakout, this was the second leg, just a single bar. At this point, traders are hopeful that this is a bull breakout below this bear channel and that it results in a measuring gap. Maybe they'll look at it as a double bottom, this low, that low, and a bear break below a double bottom. A double bottom is a trading range. A lot of traders are hoping that this is a bear breakout below the bottom of a trading range. But is it really? We're still above this low. This may be a sell vacuum test to the bottom of a bigger trading range down here. Yes, we've broken below a double bottom, good for the bears. Big tail on the bottom of the bar. The bars are not all that big. We're still above the bottom of the bull trend. This could be a second leg trap. Again, a complex 2 legs down. This could be the first leg down, and then a pullback, and then a strong second attempt down. You got to watch out, it could fail. The bears hope it's a double top bear flag. So bear trend, double top bear flag. The bears hope it's a failed breakout below a double bottom, but look to the left. We still might be in a trading range. And look at the follow through after the breakout and then the reversal up at a second bar. At this point, a lot of the bears would be concluding that it's a second leg trap and that we're going to have more trading range price action to the right, which we did. This could be the first leg down. You could say this is the first leg down. All of this is the pullback from the first leg down. You can call it an expanding triangle or trading range. So first leg down, and then a pullback, a complex pullback, and then a second leg down. And the second leg down failed. Trapped traders into selling low in what would possibly be a trading range. Again, we're below the bottom here, and this big tail here, and the bad follow through after bear bars here, bear, bull, bear, bull, bear, bull. It looks like the bears are taking control, but as soon as they broke below the bottom of this upper range here, they had a big tail here. They tried to resume down, a gap close of this bar below that low, immediately reversed up. So these bears are, at this point, really concerned. They look to the left and say, uh-oh, maybe this is not a successful breakout. Maybe this is just the second leg down in a big trading range. Trading ranges are filled with two-legged moves. One leg up, pull back, second leg up. One leg down, pull back, second leg down. Second leg traps, they always look strong enough so that traders believe the odds are there'll be one more leg up. But instead, you get the reversal. You have to be very careful buying above a bull channel. You have to be very careful buying near the bottom of what appears to be a trading range. The second legs are often stronger than the first. This clearly is stronger than that. This is not really stronger than that, but it's still a fairly strong second leg. Just like two legs up here, this second leg is stronger than that first leg. And it's always tricking beginners into believing that it's a successful breakout. It is of these past 20 bars, but not above the top of the entire range. And the beginners buy here or they buy up here. They sell down here, hoping for the breakout, ignoring the reality that 80% of trading range breakout attempts fail, no matter how strong they are. And very often, the second leg is especially strong, looking like it's going to result in a breakout, but it does not. Bears get trapped into selling low, just like bulls get trapped into buying high. And if you do buy up here, you have to get out, especially a second entry short with bear bars. If you do sell down here, not a very strong breakout, I think you have to get out above this bar, a failed breakout below this double bottom, and a higher low still in this trading range. Again, another second leg trap, two legs up, the second leg stronger than the first, Beginners buy, they only see this, and they ignore this. They ignore that we're still within the trading range. Here, you can say this is above that low, and maybe this is the start of a broad bull channel. So we have a higher low, strong second leg up, maybe we'll get a higher high. And it could be. However, it's also possible to be a second leg trap in a trading range. And whenever the market is in the top third of what appears to be a trading range, or what could reasonably be a trading range, I think it's better to look to take profits and begin to look to sell. This is what the bulls are hoping. They have a higher low, and they're hoping that this will be above that, and that we're in a broad bull channel, and they can take profits above that high. However, once you see this, you got to get out. You have to assume it's probably a trading range, especially when it's a second leg, one pullback two, especially when it's a strong second leg followed by a strong bear reversal bar. Strong sell-off, 5 consecutive bars here. Bears are hoping that it's a lower high, and maybe it's the start of a bear trend, and maybe it'll sell off below this low. They want a broad bear channel, but I always assume it's a trading range unless I have strong evidence to believe otherwise. In this video, I talked about how every trading range always contains both a reasonable buy and a reasonable sell setup. I then moved on to breakout mode when a trading range has gone on long enough and the price action indicates that a breakout is probably going to be happening soon. You have to be prepared for the breakout. 50% chance the first breakout attempt up or down will fail. 50% chance that the profitable final successful breakout will be up. 50% chance it'll be down. And second leg traps. They occur in broad bull and bear channels, and they especially occur in trading ranges. Whenever you see an especially strong second leg up or down, look to the left. Has the breakout gone far above all the bars to the left, or could it simply be a test of the top or bottom of the trading range? In which case, you have to assume it's a second leg trap and that it will reverse. So do not buy high and do not sell low unless you're sure the trading range has ended and that a successful breakout is underway. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 6 videos on trading ranges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 6 videos on trading ranges. I'll begin by talking about how trading ranges lead to either trend resumption or trend reversal. And next I'll talk about legs. Are they the start of a trend, or are they simply a leg within a trading range? Every trading range always contains at least one buy setup and one sell setup. In general, I don't use the term trading range unless a pullback has 20 or more bars. If a pullback in a trend lasts only 5 or 10 bars, chances are the trend will resume. Once the pullback grows to 20, 30, or 40 bars, the probability of trend resumption drops to about 50%, and the probability of trend reversal increases to about 50%. Every trading range, such as this, has both a trend reversal pattern and a trend resumption pattern. For example, the bulls can argue that the market's getting higher lows and therefore it is a broad bull channel. The bears in this particular case could argue lower highs, so a bear channel, the early stages of a bear channel, or a head and shoulders top, left shoulder, head, or right shoulder. And you can call it a high major trend reversal, a wedge, 1, 2, 3. You can call this a lower high major trend reversal. Here's a bear trend and then a trading range. If the bear trend resumes down, then the day will become a bear trend day. opening on the high, closing on the low. On the other hand, if it reverses up and gets back to near the open of the day will be simply a trading range day. Bear breakout of a triangle. Not great follow through, but we still got a second leg down. That is trend resumption. So a bear trend, a trading range, and now the bear trend is resuming down, continuing down. Bull trend, channel, evolved into a trading range, and now you could argue that we have a wedge bull flag, 3 pushes down, 1, 2, or 3, and we're trying to get a bull breakout, but so far not very good. If the market resumes up, then the day will end up as a trend day, a bull trend day, opening on the low, closing on its high. On the other hand, if the bears get a higher high major trend reversal and bear breakout, the day becomes a trading range day, closing down near the open. In this particular case, we got a bear breakout and another bear breakout, and we closed near the open, and the day became a trend reversal day, or you can simply say a trading range day. If this is a 5-minute chart, on the daily chart, this would be a doji, close near the open, and it would be a trading range day. Once the market has a pullback that grows to 20 or more bars, the chance of trend resumption equals the chance of trend reversal, and I call that breakout mode. If there's a trend reversal, it's usually a major trend reversal, like a higher low major trend reversal. If it's trend resumption, it could be a double top, or in this particular case, maybe a wedge bear flag, 3 pushes up, 1, 2, 3. It does not matter that the first push up of the wedge began before the final push down of the bear trend. That is very common. The bulls see this as a double bottom, higher low major trend reversal, or simply a higher low major trend reversal. And the bears see it as a wedge bear flag, bear trend, a pullback to about 50%, 3 pushes up, 1, 2. Some computers see it as basically a big low 2 short, leg 1, pullback, leg 2. A bull trend and then a trading range that began probably over here. You could argue that it began here. In any case, it's more than 20 bars, and therefore the market is in breakout mode. And you have to assume that there is both a reasonable sell, here we have a double top lower high, major trend reversal, and a reasonable buy. You can call it a double bottom bull flag or a triangle, and then a bull breakout and a pullback from that breakout. The probability of a resumption of the trend up is about the same as the probability of a reversal down. And that's always the case in a trading range. There's always a good bull setup and there's always a good bear setup. In this particular case, this little bull breakout had a pullback followed by a trend resumption up. Bull trend. Where did the pullback begin? Did it begin here, or here, or here, or here? Doesn't matter. In any case, it went more than 20 bars. And when you have a pullback that grows to 20 or more bars, I start calling it a trading range. And when that's the case, the probability that the bull trend will resume up falls to about the same as the probability of the bear trend reversing down. The bears see this as a small double top, lower high, major trend reversal. Bull trend, bear breakout, double top, lower high. The bulls see it as either a triangle bull flag or a double bottom bull flag. Both are reasonable. Here we got trend reversal down. Bear trend and a pullback, a sideways pullback. Once it grows to 20 or more bars, the probability of a trend reversal up becomes almost as high as the probability of a trend resumption down. I say almost, it's basically 50-50. Maybe it's 51% chance of a bear trend, maybe 49% chance of a bull trend. In any case, there's always a good reasonable buy setup and a good reasonable sell setup once a pullback grows to 20 or more bars. For the bulls, a higher low major trend reversal or a triangle bottom, and for the bears, a double top bear flag or a triangle bear flag. And here we got a bull breakout. Up here, it still could be another sell setup. 2 legs up, 1 pullback 2. It could be a large low 2 bear flag. And in fact, that's what it turned out to be. The bears got trend resumption down. Not a big bear trend, but they still got trend resumption down for about 30 or 40 bars. Bear trend. The pullback began here. It grew here. We tried to get a low 2 short, leg 1, pullback, leg 2, decent sell signal bar. But instead of down, the pullback continued to add bars. And after about 20 bars, the probability that you'll get a trend reversal up becomes just about as high as the probability that you'll get trend resumption down. What type of bottom is it? It doesn't matter what you call it. You can call it a double bottom, higher low, major trend reversal here. You can call it a double bottom, higher low, major trend reversal there. You can call this a low 2 short, leg 1, pullback, leg 2. You can call it a triangle. You can call it a rounded bottom. You can say there's accumulation going on. It doesn't matter what you call it. Once you have about 20 bars or more in a pullback, it's a trading range and the market's in breakout mode, and the probability is 50-50 that the market will go up or down. Whenever it's in breakout mode, the first breakout up or down only has a 50% chance of success. But once there is a successful breakout, the probability that the successful breakout is up is about the same as the probability that it would be down. Here we got a bull breakout, a pullback, and then a series of bull trend bars. If this is a bear flag, we got a bull breakout of the bear flag, and then we got a sustained bull breakout with 5 consecutive bull bars. A by the close bull trend, probably going higher. A bull trend and a deep pullback. Does the trading range continue all the way to here, or is this the end of the pullback? Some computers would conclude that it already has trend resumption up. Bull trend, pullback, wedge bull flag, 1, 2, 3. Does not matter that 2 is above 1. It's a double bottom and a bear breakout. That's a type of a wedge bull flag. And now we're getting trend resumption up. A bull breakout followed by a deep pullback. And the bull channel has a wedge shape. You can call it a broad bull channel. You can call it a broad wedge bull channel. In any case, it's still a bull channel, a bull trend. Two-sided tradings, whenever you have a broad bull channel, you always have deep swings down. And at times, the market can even become always in short when you have a broad channel. Because of the strong selling here, here, and here, and the bears are able to make money not only with limit orders, but with stop orders selling below bars, the channel is probably soon going to transition into a trading range. Remember the market cycle, you get a very strong breakout, a bull trend, and then a pullback, and then a channel, and the channel usually evolves into a trading range. A channel is usually the first leg of what will become a trading range. Even though it's still part of the bull trend, it usually ends up part of a trading range, as it did here. Bull trend, bull breakout, deep pullback, and now a channel. And the channel, 75% of the time, will have a bear breakout below the bottom of the channel, and the channel will evolve into a trading range. Bull channel, bear flag, 75% chance you get a bear breakout. And the breakout can be by going sideways or by going down. Usually tests a major higher low. For example, this is a major higher low, a strong rally to a new high. This is another major higher low. It usually comes down to test major higher lows. This is not so major because the breakout's not so strong. But here or here, reasonable targets for the bottom of the trading range. This might be the bottom. It might continue further down to here and then have a leg up. So leg up, leg down, maybe a leg up afterwards. Bear channel, 75% chance you're going to have a bull breakout. Whenever you see a bear channel, you should think of it as a bull flag. And the target is usually the top of the channel. This is not really a strong bear breakout, but a deep pullback this is probably the start of the channel phase. Usually when you get a reversal up above the top of the channel, the first target is the start of the bear channel, which is this high, and then an evolution into a trading range. This first rally, probably the start of a trading range, even though at the time you don't know that. And this bear channel is probably part of the trading range, even though at the time it's also still part of the bear trend. Bear trend, bull breakout, bear trend, bull breakout. Fairly tight bear channel. Whenever you have a fairly tight bear channel and then you have a bull breakout, chances are the reversal up is minor. A minor reversal usually leads to either a trading range or a resumption of the bear trend. On a higher time frame chart, a very tight channel like this is a breakout. So if you get a pullback, it's like a bull breakout above a micro channel on a higher time frame chart. The odds are traders will sell the first breakout to the upside. We have a gap this low, that high. We have another surprisingly big gap right here. This closed below that low, and this pullback below that low. You have to be thinking that maybe this is a measuring gap, and maybe the bulls will not buy until it gets down to around a measured move. Maybe the bears will not take profits until it gets down to around a measured move. And now we have a double top bear flag also testing that low. And you can see once the market got down to about a measured move, the buyers came in. The bears bought back their shorts and the bulls bought. Bear breakout, good follow through, another bear bar. Measuring gap more likely than an exhaustion gap. I'm now going to talk about whether a move is the start of a trend or a leg in a trading range. Clearly a bear trend. However, this is not the best follow-through. It's not a bull bar, so it's not terrible follow-through, but it's also not a bear bar. The biggest bear bar, 15 or 20 bars into a bear trend, and then this kind of follow-through, you have to be wondering, is this a bear leg in a trading range? Bear bar here, doji here. Bear bar here, bull bar here. Bear bar here, not big, doji bar. Bear bar, bull bar. A pair of bear bars, but then a doji bar. The bear bars are getting bad follow-through, so you have to be suspicious that maybe this is more likely a bear leg and what will end up as a trading range instead of a bear trend that continues on for a long way. The bulls are buying the bear closes, betting against a strong bear trend. And the bears are taking quick profits. They're selling maybe above bars, maybe at that high, and as soon as they get enough for a scalp, they buy. And the bears are buying, creating a bar like that. So the bears are not confident of lower prices. Once they get a strong bear bar, they use it to take profits instead of saying, oh, it's a sell the closed bear trend. I better sell because it's going lower. The bears are not confident. Bad follow through, consecutive sell climaxes, big bear bar, sell climax, sell climax, sell climax, sell climax, sell climax. You have to be thinking that this is probably an exhaustive end of a move and the conversion into a trading range rather than the start of a new leg down. We have a gap this high, that low. Is this bar more likely a measuring gap leading to a measured move down? Or is this telling us that this entire sell-off is probably a bear leg in a trading range? If it's a trading range, you have to assume that the market will go above resistance, and obvious resistance is this low. Probably an exhaustion gap. The biggest bear bar, 20 bars into a bear trend. The bear trend not all that strong. More likely a bear leg in what would become a trading range. Traders expect a bull breakout and then a trading range. The bears are scalping and they're taking quick profits, and the bulls are looking for opposite trades. You can see the reversal, and then once we have a big reversal, we have big down, big up, big confusion. You have to assume the market's going to go sideways, and once it is sideways, bears will look to sell second entry shorts, first entry, second entry. Bulls will look to buy second entry buys in the bottom half, first entry, second entry. and they'll scalp. They'll take quick profits because they doubt the moves will go very far. Once traders start to believe that the downside is limited, they'll begin to trade it like a trading range. Even if it's still in a broad bear channel, we're still getting lower highs and lower lows, even though this low is above that low. So it's still a bear channel, but the reversals up are big enough for bulls to make money buying. Whenever the market's in a broad bear channel, traders usually trade it like a trading range. They buy low, sell high, and scalp, because a broad bear channel like this also is a trading range for much of the time. Traders often use wide stops because they're not confident that the first reversal up will be the final reversal up. Traders also tend to use wide stops, and they're willing to scale in. For example, if a trader buys here, he might not put a stop here. He might look at this and say, well, trading range, yes, but strong enough bear breakout might get one more leg down. So maybe I'll put my stop, a measured move down, somewhere down here, and then look to buy if we get a second reversal up. So he buys here, and then he buys more there or more here. Traders are never really certain where the top and bottom of the range will be, but they are very confident that it will not be too far. So they're willing to use wide stops and scale in. And because they don't think the market will go very far up or down, they take quick profits. They scalp. Strong bear close, bulls will buy it, betting on an exhaustion gap. A reversal down, strong bear close in the bottom third of a developing trading range, bulls will buy it, betting that the bear breakout will fail. Bulls will buy that bear close. They'll buy this low, betting the bear breakout will fail, and they'll add on lower. And bears sell rallies. They see a strong bull bar, and they'll bet against this being a measuring gap. They'll bet that it'll trade back down, maybe down here, double top bear flag, and they'll expect this gap to close. You can see this low fell below that high. They'll sell more on the reversal down. A weak bull flag, only a doji. This bull bar has bad follow through. It has a tail. It's a lower high. A bad bear flag. Traders will sell at a limit order at that high. Even here, a strong bull bar closing on its high, but near the top of a developing trading range. Some bears will sell at that high and get filled there. Others will sell this micro double top. First attempt down, second attempt down, especially because it's also a double top with this. Again, a weak bull flag, the top of a tight trading range, near the top of a big trading range. Traders will sell above that bull bar, or they'll sell below this bear bar or below that bear bar, betting that the bull breakout attempt will fail. When the market gets to a new low, instead of bears selling more, they take profits. They buy back their shorts on strong bear closes and on new lows. New low, bears will take profits. Strong bear close on the low, bears will take profits, betting against a continued trend down. And bulls will do the opposite. They know the bears are taking profits, and they know the probability that this will become a strong bear trend is low. Remember my 80% rule. 80% of the time, if you have a trading range and you have an attempt at a strong bull breakout or a strong bear breakout, it will fail and reverse. Strong bull breakout, and then a high 2 bull flag, high 1, and then high 2. Consecutive bull bars, the body's getting bigger, closing on their high or near their high. No pullback in 5 bars, 1 and then 3 and then one more here, so that's 5 bars. 5 bar bull microchannel. Even with this bear bar, probably buyers below for at least a little bit more up. Maybe here, maybe here. Higher price is likely, so better to only look to buy. Probably with a strong bull breakout like this, we'll get some kind of measured move up, maybe based upon the breakout. Maybe the open of the first bar, close of the final bar, measured move up here. Strong bull breakout, pullback, probably a channel, and then a trading range. Spike and channel bull trend. Bull breakout, so a spike up, a pullback, and then the channel. A lot of little reversals along the way, so it's a channel. And usually a spike in channel bull trend has a bear breakout and then it evolves into a trading range. Not a lot of consecutive big bull trend bars, especially later in the trend. We have a pair here, but then you start getting bear bars after bull bars. Bull bar, small follow through, then a couple bear bars. Bull bar, doji. Bull bar, but big tail on top. This is looking like a bull leg in what will become a trading range. Many pullbacks, minor reversals, tails on the tops of bars, lots of overlap, small tight trading ranges. This does not look like the start of a big bull trend. It looks like a bull trend that will soon evolve into a trading range. And it did. Bull channel, bear flag, 75% chance you'll get a bear breakout. Spike pullback channel probably will evolve into a trading range. Market cycle. Strong bull breakout, bull channel, and then trading range. And then the market decides whether to resume up or reverse down. I said that a lot of times when you have a bull breakout like that, one of the first things I look for is a measured move up based upon the bodies of the bull bars. So the open of the first bar, maybe the low of the first bar, and the close of the final bar of the breakout. You can also get a leg 1, leg 2 measured move. Leg 1, pullback, maybe leg 2. Whenever you have a bull breakout and a pullback and then a channel, you have to be thinking about possibly 3 pushes up. 1, 2, 3, and then a trading range. On the other hand, here, a breakout with follow through, and then look at this bar. The low of this bar is around the high of that bar. I can't tell if they overlap, but in any case, it's a gap or a negative gap, and therefore it might result in a measured move up, and this bar could become a measuring gap. And maybe we get a bigger 3 pushes up. 1, 2, 3, maybe a nested 1, 2, 3, 1, 2, 3. Measured move up based upon the open of the first bar, close of the final bar of the breakout. You can see some profit taking at that level. Leg 1, leg 2, leg 1, the bull breakout, and then the bottom of the pullback, leg 2. Profit taking at that level, the bull's taking profits. Aggressive bears might sell there as well, but when the pullbacks are this small, 1 or 2 bars and not very far down, it's usually better only to buy, not sell. We tried to get a wedge top, 1, 2, 3, got a bull breakout above the wedge top, a pullback, looks like a perfect breakout test of that high, and then a measured move up. We got to that measured move target, look what happened. Profit taking, maybe some bears selling, at least for a scalp. In a bull channel, especially a tight bull channel with very small pullbacks, it's better to only look to buy. And bulls can swing or scalp. A good buy below that bear bar, betting that the bear reversal will fail. Another 2 bars up, even though a decent bear bar, more likely a pullback from the breakout above this high. Consecutive bull bars closing on their highs, probably buyers below. A breakout above potentially a wedge top, probably will get at least a small second leg up. Bulls will buy that close or that close. A high one buy, a pullback after the breakout. Perfect breakout test. This low pulled back and tested that breakout point. Buy on the resumption up. And bulls, as I said, will buy for either a swing or for a scalp. Bears see this as well, a spike in channel, and they know it's probably going to have a bear swing and then form a trading range. So at some point, bears begin to look to sell. And when they sell, they're not selling initially with stops. The channel is too tight, the pullbacks are too small. However, they will start to sell with limit orders at a prior high, for example, sell here, and then they'll place a limit order to sell at this high and get filled there, and they'll use wide stops, and many of them are willing to scale in higher. They'll also sell strong bull closes here and here, although I don't have it indicated here, betting that the bull breakouts will get pullbacks. Initially, the bears are only looking for scalps. The market's still always in long in a fairly tight channel. But they'll sell, use wide stops, and scale in higher, betting that the bull channel will soon evolve into a trading range. Three consecutive bear bars. Look back here. When's the last time you've seen 3 consecutive bear bars? you haven't. And 3 pushes up, 1, 2, 3, around measured move targets over here. A lot of bears will now start betting that these bull flags will fail and that this is probably near the top of a trading range. So when they see 3 bear bars, they'll place a limit order to sell at the high of the bar and they'll get filled here. Again, they probably have to use a fairly wide stop. Initially, they sell at prior highs, and then at some point, once they start to see consecutive bear bars, here 3 bear bars, they'll start selling above the high of the bear bar, betting that we will not even get to a new high, that will get at least a small second leg down. As the sell-off gets stronger, bears become more aggressive. Here's a bear bar and a follow-through bar. They might sell that close. They might sell below this inside bar. We're trying to reverse up, but a small reversal and a lower high, they'll sell below that bar, betting that the bear swing will continue down. 2 small legs up, 1 pull back 2, they'll sell below that bar. It's becoming a bear trend. Are we still always in long? You could argue that we're always in short here because we're probably going a little bit lower. But once you start to get 4 or 5 consecutive bear bars, we're probably always in short and we're probably going at least somewhat lower. This low stayed above that low, above the bottom of the channel. If you're looking for very few reversals, you can argue that this is simply a pullback from this bull trend, a 50% pullback, and therefore it's still always in long. And that's true on a higher time frame chart. But on this chart, I think it probably became always in short here. So if you're trading this chart, I think it's okay to sell, betting that we're going down at least a little further. 3 buy signal bars, 1, 2, 3, 2 of them triggered. This is a good place to get out of shorts, and bulls will start looking to buy here around a 50% pullback, betting on a bull leg in the developing trading range. Strong bear breakout, terrible follow through for the bears. 9-bar bull microchannel, 9 bars without a pullback. This low did not fall below that low, and none of these lows fell below the low of the prior bar until this bar. This bar fell below that low. But a 9-bar bull microchannel and a reversal up, probably buyers below and higher prices. On a higher time frame chart, this is a breakout, a spike. This is also a spike, pullback, and then channel. Is this spike and channel the start of a strong bull trend, or is it simply a big leg in a developing trading range? We got a breakout here. We tried to top out here, we tried to get a double top lower high. Instead, we got a bull breakout and the gap stayed open. The pullback here stayed above that low. Maybe this will lead to a measured move up. In any case, this breakout and the context are good enough to make the traders believe we're going at least a little bit higher. I'm always looking at context, and by context I mean the bars to the left. Is the market already in a big trading range? Is the trend getting closer to support or resistance? Does this look like a strong bull trend? Are there consecutive big bull trend bars closing on their highs, or do bull bars have tails on top? Do bull bars lead to bear bars? Are there a lot of small dojis? If that's the case, then even though it's still in a bull trend, it probably is soon going to evolve into a trading range. Is it stalling near a prior high? Here, and then again here. If so, that increases the chances that the entire trend is probably a bull leg in what will become a trading range. Disappointing rally. We've been rallying for 20 or 30 bars, not making much progress, and now we're getting a fairly deep pullback. No consecutive big bull trend bars. Every bar or two, there's a pullback. A lot of bear bars on the way up. Pullback here is fairly deep in this channel. This is all trading range price action, and it makes it likely that this bull channel will end up part of a trading range. And it was part of a trading range for the next 30 bars or so. Trading range, if this is a 5-minute chart, this was a trading range for about 4 hours. This rally has 3 consecutive bull bars, but are they big bull bars closing on their highs? No, they're relatively small bull bars. This one closes on its high, but these two have tails. When I see that, and then I see another bull breakout, not a very big bar, not strong follow through, trying to go outside up, tail on top, followed by a bear bar. This rally, even though we're clearly going up, looks weak, and therefore it's probably going to be a bull leg in a trading range and not the start of a bull trend that goes up much further. We're breaking above the highest bar to the left, and look what happened as soon as we broke out. We have a big bear bar closing on its low at the low of the prior bar. This is not how strong trends behave. So when I see a bull trend like this, it's probably going to soon be part of a trading range. No consecutive big bull bars. The bull bodies are small. Pullbacks every few bars. Lots of reversals. Some of the reversals are fairly big and contain a lot of bars. This does not look like a bull trend. It's more likely a bull leg in what would be a trading range. So bull trend, yes, but probably later on, when you look back at this, you'll say, oh, this was just a bull leg in a trading range. This was a bear leg in a trading range, a bull leg in a trading range. And it was. We have a bear channel. Fairly broad. This rally has about 15 bars in it. This rally has 4 consecutive bull bars, but it's still making lower highs and lower lows. Remember, broad bear channels often have times when the market is actually always in long. Maybe it's always in long here. Maybe this will be a higher low for a second leg up. Most of the time, when the market's in a broad channel, it's also in a trading range. And because that's the case, traders look to buy low, sell high, and scalp, just as they do within a trading range. A sell-off, but no consecutive big bear bars. You can say, well, Al, this is a whole bunch of bear bars here. Well, where are the consecutive big bear bars? Bear bar, bull bar, bear bar, small, bull bar, bear bar, doji, bull bar. We're going sideways within yesterday's range. This is more likely a bear swing in what will end up as a trading range. Very good reversal and a follow-through bar, but still below this micro double top. That increases the chances that this is just a test of the high and part of a developing bear channel or a bull leg in a trading range. For the bears, it's a small double top and a bigger double top and a lower high. Look at the reversal down. Big bear bar, bad follow through. A pair of bear bars and then bull bar, and then a doji, tails on the bottoms of these bars. Does this look like it's going to break below this neckline of this double top and fall for a big swing down? Or does this look like a bear leg and what will end up as a trading range? Bad follow through selling, still above the bottom of the bull reversal. This is probably a bear leg in what would be a trading range. It might also be a bull flag. So it could be a bull reversal and then a deep pullback followed by trend resumption up. In any case, it does not look like a strong bear trend. And you can see what followed. We have big down, big up, big confusion, usually means a trading range. We have big up and a very deep pullback, probably trading range. Here's the euro versus the dollar 5-minute chart. You can draw lines across the top, across the bottom. We broke below the first line, so you draw another line on the reversal up. And we have a pair of decent bull bars here, but then a bear bar. And then another pair of bull bars, but a tail closed barely at that high, and then a bear bar. A strong bull bar here, and then a bear bar. And then we got a couple bull bars and then a couple dojis. A bull bar and then a bar with a big tail. It looks like this is a strong bull trend evolving into a weak bull trend, a fairly broad channel. This probably will soon become a trading range. So bull trend, but probably a bull trend that is a leg in a developing trading range. And you can see what followed. Strong bear trend and a pullback, still pretty good bear trend. But now look what's happening. Bear bar and then a pair of bull bars, bear bar, bull bar, 3 bear bars, break out to a new low, and then a reversal up, and then repeated reversals. So we have a strong bear trend and now a weaker bear trend. This looks like it's evolving into a trading range. Probably not much more down before we start to go sideways and test these lower highs. A bear channel, but lots of two-sided trading within the channel. Lots of reversals, lack of strong consecutive bear bars. Bear channel, bull flag, 75% chance at some point you get a bull breakout. Here, in fact, we ended up with a trend reversal. Bull breakout above a bear trend, and then a higher low major trend reversal. This entire rally, as strong as it is still below that high, and it probably will end up being a large bull leg in a big trading range. Too early to tell. Strong bear breakout, 4 consecutive bear bars closing on their lows. But then look what happens here. We're starting to get dojis, and we're starting to get bull bars after the bear bars. Trying to get strong again on the part of the bears, but then we got a 6-bar rally, and then a tight trading range. The bears are losing interest in selling low. Fairly tight channel, but lots of small dojis. Tight channel lasting 20 or more bars, probably climactic, especially when so many of the bars are dojis. Probably not much more down, and it's likely soon to get a bull breakout and then become a trading range. This looks like trading range price action. Even though it's a continuation of this bear trend, the bears are losing steam. They're losing momentum. We're starting to get a lot of small sideways bars. That's a sign that the bear channel is weakening. And what does the market tell you? That when you get a channel that's weakening, probably it's the early stages of a trading range. "70 to 75% chance you'll get a bull breakout, and maybe a couple legs sideways to up," which we did. First leg up, broke above the bear channel, and then a small higher low. Maybe not enough bars for a major trend reversal. It turned out that it did lead to a fairly major trend reversal. 2 legs up, 1 pullback 2, in a developing trading range. No surprise that we start to pull back. Strong bear breakout, euro versus the dollar, 5-minute chart, and then a channel, pullbacks every few bars. Lots of reversals, lots of bull bars. Where are the consecutive big bear bars closing on their lows? That's what you'd expect to see in a bear trend that's going to go for a long distance. This does not have that. This is probably a bear leg in what will become a trading range. Strong bull breakout, probably at least a second leg up. So first leg ends here, pullback, second leg, maybe more up, but at least a second leg up. Bear channel. Sometimes it evolves into a trading range. Sometimes it reverses into a bull trend. It's a small bull trend, but we're stalling at the top of the range to the left. So this might also be simply a bull leg in what will become a trading range. Why did the bulls allow all of these bear bars? Is that typical of a strong bull trend? Also, why are we hesitating getting a double top here at a prior high? Bad follow-through buying, just like this was a weak bear trend and probably a bear leg in a trading range. This initially was strong, but it's becoming weak now. It's probably a bull leg in a trading range. And you can see bear breakout below the bull channel and then sideways for a lot of bars. When traders believe the market is just a leg in a trading range, they're confident that a rally will not go up too far before there's a bear leg in the trading range as well. And they're also confident that a bear leg will not get down too far before there's a bull leg. They're looking to buy low, sell high, and take quick profits, scalp. Bulls use new highs to take profits, and bears use new highs to sell. They sell and sell more higher. Bulls use new lows to buy, and bears use new lows to take profits. The bulls who do buy are using wide stops, scaling in and scalping. On the way up, the bears who are selling are using wide stops, scaling in and scalping. Both are confident that no matter how strong a leg up or down appears, it's probably not going to get too far before there's another reversal. When the bears see a strong bull close near the top of the range, they sell it, betting that the bulls will not get consecutive big bull trend bars. When bulls see a strong bear bar fairly far down in the range, they buy it, betting that the bears will not get a successful breakout and a measured move down. They'll bet that this gap will become an exhaustion gap and that there'll be a profitable scalp on the way up. With both bulls and bears buying low and selling high, chances are there's going to be a trading range. Bulls are buying low to put on long positions. Bears are buying low to take profits. Bulls are selling high to take profits, and bears are selling high to initiate shorts. And that's how to trade in a trading range. You buy low, and you sell high, and you take relatively quick profits. And that creates a trading range. In this video, I talked about whether or not a trend that leads to a trading range will get trend resumption or trend reversal after the trading range. And then I talked about trends and whether or not they're actually a trend or a leg or swing within a trading range. If there's bad follow through, if there's a lack of consecutive strong trend bars, chances are the trend is simply a leg in a trading range. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 6 videos on trading ranges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 6 videos on trading ranges. I'm going to begin by talking about tight trading ranges. Those are trading ranges where the height from the bottom to the top is not very big. It's very difficult to make money entering with stop orders when the range is very tight. In fact, if the range is tight, most traders should not trade. And then I'll move on to talk about limit order markets, which in general are tight trading ranges, and traders who are going to trade them are buying below bars near the bottom using limit orders, wide stops scaling in, and they're using limit orders selling above bars near the top. Sometimes on television you'll hear traders talk about dead money, and they're usually talking about the daily chart, and usually after a big move down, like this, a very big bear trend, and then you start to get small sideways bars. The idea is if this is a daily chart, this is several months of trading, you're not going to make money trading here, buying or selling. It's better off looking elsewhere to trade. Whenever the market goes sideways for even 2 or 3 bars, usually 10, 20, or 30 bars in a very narrow range from top to bottom, I call it a tight trading range. Most traders should not trade when the market looks like that on any time frame. Let's say this is a daily or weekly or monthly chart of a stock. It has a big bear trend, and then it starts to get a lot of overlapping bars, very prominent tails, small bodies, lots of dojis. That is a dead money type of chart. I use the term tight trading range. If it goes sideways for 20 or more bars, you should look elsewhere to trade because it's very difficult to make money in this kind of environment. Tight trading ranges are common and they occur on all time frames and in all markets. When you see them, most traders should look elsewhere to trade. The concept behind dead money, in a stock, for example, it sells off and then it goes sideways. The idea is that it has to go a long time before bulls believe the bear trend has stopped. And after about 20 or 30 bars, the probability of a trend reversal up becomes as high as the probability for trend reversal down. During this process, 20, 30, 40, 50 bars, 100 bars, very little profit potential. No return on investment, so it's dead money, and you should trade elsewhere. In general, whenever you see a trading range, you should look to buy low, sell high, and scalp. If a scalper cannot make money buying low or selling high, using stop orders to enter, then the trading range is tight. If you sell here, you don't make money. You buy here, not enough room to make money. That is one way to determine if a trading range is tight. If you look at the chart and stop order, traders are not making money, then the range is tight and it's better not to trade the market. Selling here, selling here, selling here, you're not making money. Selling here, not making money. Buying here, buying here, buying here, buying here, not making money. Buying here. Whenever it's difficult to make money, even buying low and selling high, if you're using stop orders, the trading range is tight and therefore you should not trade. Here are examples. Lots of entry setups, but very few profitable trades. A limit order market, not good for stops, therefore a tight trading range. Same thing here. Rather than trading this and not making any money and taking a lot of trades every little reversal, it's better to wait for a breakout up or down before trading again. Here we got a little breakout and some follow through. This looks like it could be the start of a trend. Traders might start to buy closes here, or they might buy this high to buy, 2 legs down, 1 and then a bull bar, and then 2 and then another bull bar, or a pullback from this breakout. Some traders will buy the breakout, consecutive bull bars, close above the high of the past 60, 70, 80 bars. It's not yet a big bar closing on its high, but it is an early breakout. If you do take that buy, and you are correct that this is the start of a bull trend, it should not come back below the bottom of this breakout. We have a small triangle here, 3 pushes down, bear, bear, bear bars. Then we have a small bull bar closing on its high. Traders can buy the pullback. It's a bull flag. A breakout here and a pullback from that breakout, another bull bar, buy above the high of that bar. And this is what ultimately followed. You obviously could buy closes on the way up here. Strong breakout, good follow through, high probability that we'll get some kind of measured move up. Trading range has the word range in it, and then implies that there's a top and a bottom, and therefore there's a channel, but it's horizontal. Like all channels, they can be very broad or they can be very tight. By broad, I mean a lot of room from top to bottom. Stop entry traders usually can make money buying at the bottom and then selling below bars at the top. When they're tight, very difficult to make money buying above bull bars, even very good looking bull bars like this. Usually better not to trade when they're tight. Very broad range. Traders can buy above bull bars at the bottom, sell below bear bars at the top, and plenty of room for a scalp or a swing trade. Also, when it's broad, traders can enter with limit orders, betting that breakouts will fail. They'll buy below bad-looking sell signals at the bottom of the range. They'll buy below prior lows, so they'll buy at that low. Not a good-looking bear flag, a bull body. They'll buy at the low of that bull bar, get filled here. And they'll also buy at this low, betting the breakout will fail. The opposite is true at the top. They expect a top of the range, and they'll start selling above bars. They'll sell with the limit order at the high of this bar, get filled here. They'll look at this and say, well, that's a pretty bad looking bull flag, a doji after a big bear reversal bar. They'll sell with the limit order at the high of this bar and get filled here. If it's a broad channel, you can also enter with market orders when there are strong reversals. For example, we have a good bull bar here, maybe a wedge, 1, 2, 3, maybe a wedge, 1, 2, 3, and we have a good entry bar. Some traders will buy that close or buy this close. Same thing here, spike, pullback channel, 1, 2, 3. Not a good looking buy signal bar, but a pretty good reversal up, probably at least a couple legs up, 1, pullback, 2. So traders will buy that close. Opposite is true on the way down. When you see a pretty strong reversal down, and then you see a weak attempt to reverse back up, a lot of traders will sell at the market as this bar is starting to turn down. They might get filled here, they might get filled here. And the same is true here. They see a weak buy signal bar after 2 legs up, 1 pullback, 2. And as it's starting to reverse down, traders will sell at the market. And if it's a strong leg down, here we have 3 consecutive bear bars closing below their midpoints. They'll sell the close of the bar, betting that will get down near the bottom of the range. On the other hand, if the range is very tight like this, it's better to not trade and wait for a breakout. There's always a breakout, but you might have to wait a long time. I'm now going to talk about limit order markets, which in general are very tight trading ranges. I don't have a price scale on the side of this, but the market's reversing every 2 to 3 bars. Very difficult to make money. Entering with stops, selling below bars at the top, buying above bars at the bottom, taking any trade in the middle third of the range. That is not a good stop order market, and therefore if you're going to trade, the only way you can make money is entering with limit orders, which basically is the opposite of a stop order. A limit order, for example, you're looking to buy below bars in the lower half. You buy a breakout, betting the breakout will fail. A stop order trader would sell below this bar and get filled here. A limit order trader does the opposite. He places a limit order to buy at that low. Up here, a stop order trader would buy above that high and lose money. A limit order trader would have an order to go short at that high, and as soon as the market went above that high, he would get short and he would make money. Buy zone, the bottom half or the bottom third. Sell zone, the top half or the top third. Bulls and bears both are scalping. They're expecting the range to continue and not become a trend. They know eventually it will become a trend, but as long as it's sideways, they assume it'll continue sideways. They tend to use wide stops. Many of the experienced traders will do that, and they're willing to scale in. For example, place a limit order to buy at the prior low, you get filled here. Place a limit order to buy at that low, and you get filled here. Place a limit order to sell at this high, filled here. Sell this high, get filled there. Can you simply trade all tight trading ranges with limit orders? No, it's better to have certain minimum requirements. Sometimes the tight trading range is too tight to make money. Most of the time, traders will only trade if most of the bars are at least the size of a scalp. This is the E-mini chart, a 5-minute bar chart. In general, a lot of traders will not trade unless most of the bars are at least 4 ticks tall, which is the size of a minimum scalp. They also want the height of the entire range, from top to bottom, to be at least 3 times bigger than the smallest scalp. The smallest scalp, 1 point, so they want the height of the range to be at least 3 points tall. And they also want the height of the range to be about 3 times the size of an average bar. Here, an average bar is 4 or 5 ticks tall, so before they trade, they want the height of the range to be 3 times that. The range here is 27 ticks. This is a tight range. You can see we have 6 sideways bars, 3 here, 3 or 4 here, 3 here. The market is reversing every 2 to 3 bars. However, the height of the range is 7 points tall, 28 ticks. So that's 3 times bigger than the minimum scalp, 4 ticks. And the average bar here is 8 ticks. 28 ticks is more than 3 times that as well. Therefore, even though it's a tight trading range, many experienced traders are willing to trade with scalps using limit orders. Most traders, they should not trade whenever the range is tight. The profit potential is small, it's a lot of work, and it's easy to lose money with just a couple mistakes. If it's tight, but big enough for scalps, some traders will trade with limit orders. Again, if it's tight, you should not be entering with stop orders, because most of the breakouts will not go far enough for a swing trade. Most of the breakouts won't go far enough for a scalp, and you don't want to be buying too high or selling too low when the range is tight, because you have to bet that each leg up or down is going to reverse within a few bars. Another tight trading range, lots of reversals. The legs up and down only go a few bars before you get a reversal. Every bear bar followed by a bull bar, every couple bear bars followed by a bull bar. Bulls and bears both believe that a big move up or down is unlikely. The market is going sideways, lots of overlapping bars, prominent tails, bull bars followed by bear bars followed by bull bars, here and here, here and here. A big move up or down is not likely. Bulls will buy below bars in the lower half, betting that bear breakouts will fail. However, because they believe the move won't go up too high, they take quick profits, they scalp. They buy at prior lows. The market's going down, they place a limit order to buy at that low, they get filled here. Market's working lower, they place a buy order to buy at that low, filled here. And the opposite for the bears. The market's trying to go up, bears will look to sell above prior highs. Here, they get filled. They might have a limit order to sell here as well. A prior high here, they get filled. They might have a limit order to sell here as well. Did not get there. Both will scalp because they do not believe the market will go far enough for a swing trade, and many will scale in and use wide stops. A lot of times they'll enter, not certain if the market is about to reverse, but they are certain it will not go much lower. So for example, a bull who bought here, if he did not take profits up here, he may buy more here, betting that the market's not going to fall too far and it will reverse soon and he'll be able to make a profit. This is the euro versus the dollar, a 5-minute chart. How far should your stops be if you're looking for a minimum scalp? When you're trading forex markets in general, you should always trade for at least a 10 pip profit. If you're trading with limit orders in a limit order market like this, a tight trading range, usually you have to risk 30 pips, sometimes as much as 50 pips, and you usually have to be willing to scale in. Most traders cannot do that, and they're better off not trading when the market looks like this. For example, a bear might sell at this high, get filled here, place a limit order to sell more 10 pips higher, and maybe a stop 30 pips above his first entry. And then when it comes back down to his first entry, he gets out break even on this entry over here, and he gets out with a profit on this entry. He might buy here, and he might be willing to buy more 10 pips lower. It did not fall 10 pips lower, so he did not have an opportunity to add to his position, scale in. And scalpers are going to be taking minimum scalps. The range is tight. It's a 40 pip tall range. Most scalpers will be trading for 10 pip scalps. Lots of opportunities, and it looks easy, but in fact, it's very difficult to do. Most traders should not be doing this. Whenever you see a tight trading range, you should conclude that neither the bulls nor the bears have a big advantage. The market would not be in a tight trading range if one side or the other had an advantage. It would be trending up or down. When it's in a tight trading range, 50% chance you'll get a bull breakout, 50% chance you'll get a bear breakout. Tight trading range, the bulls see some kind of a bottom, a double bottom, lower low double bottom, the bears see a double top bear flag. Not quite 20 bars, so not quite equal probability for bulls and bears. The bears still have a slight probability advantage, but not much. If they had a big probability advantage, the market would not be doing this for 10 bars. It would be doing that. Opposite is true here. We have a reversal. Most of the bars are above the moving average. It's a tight trading range, so the probability of a bear breakout is almost as high as for a bull breakout. But because most of the bars are above the moving average and we've had a reversal up, the bulls have a slightly higher probability, but not a big advantage. If they had a big advantage, the market would not be going sideways. It would be going up and up strongly. This is an important thing to notice. Very strong bull trend, a pullback, and then a resumption of the bull trend. Here we have, 8 or 9 consecutive bull bars? And then we formed a tight trading range. However, in the tight trading range, there's a small double top, and it's slightly lower high than this. This, in fact, is a double top, lower high major trend reversal. And like all major trend reversals, there's a 40% chance that the market will have a swing down. Some bears will take that chance and they'll sell below the low of the double top. So they'll sell with a stop below that bar and get filled over here. Some bears prefer to sell below a bear bar. So they might sell with a stop at the low of this bar, one tick below that bar, and then get filled over here. It never looks like it could possibly work, but whenever you see a tight trading range and a strong trend, you have to be thinking about the possibility of a double top major trend reversal. If it's a bear trend, you got to be thinking about a double bottom, high or low major trend reversal. Even though the trading range is tight, you can get a huge move. Usually you get 2 legs down if it is going to go down, and the second is usually bigger than the first. Leg 1, pull back, leg 2. Higher probability, instead of selling up there, you wait for a strong breakout and good follow through, and then you sell the close of that bear bar. Higher probability usually means higher risk. If you take that sell, your stop is either here or above the top of this sell climax. Here you're risking very little. If you sell here, you're risking at least to here, maybe to there. Whenever you have a high probability trade, you have to assume that risk reward is worse, and that usually means the risk is greater, the stop is further away. A double top, a little bit above a double top, but bull trend, tight trading range, and whenever you see a double top and a tight trading range, you have to be thinking about the possibility of a double top, lower high major trend reversal. Risk is small, and that means probability is small as well. You look at this and you say, oh, I'm going to sell below that bear bar. I'll get filled here. I'm only risking to right here. I'm not risking much, and I have huge profit potential. That is true. Whenever you have a great risk-reward setup like this, the probability of making money is small. You're probably going to lose. But mathematically, it's okay. The trader's equation is positive. In general, if it does work, you get 2 legs down, 1 pullback 2, and the second leg is often bigger than the first. Higher probability, you wait for the bear breakout and you sell either this close or you sell above the high of this bar, betting that the reversal up will fail. Here we have a low 2 short, low 1, low 2, so you can sell below the low of that bar and get filled here, or if you want, you can sell below a bear bar closing on its low and get filled here. These are higher probability shorts than that original short, but the stop is still up here, stop is further away. Whenever you have higher probability, you have to assume that risk is greater, your stop is further away. Usually your reward is less because you're entering after the trend has already gone your way and there's less profit potential left in the trade. In this video, I began by talking about tight trading ranges, and I used my definition of what a tight trading range is to determine whether or not a trader should trade it. In general, traders should not be trading in tight trading ranges. Tight trading ranges are limit order markets. If you cannot make money with stops, the only way you can make money is with limit orders. It looks easy to do, but it's very difficult to do, and most traders should not be trading in limit order markets. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 6 videos on trading ranges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 6 videos on trading ranges. I'll begin by talking about the vacuum effect, how the market gets drawn towards support and resistance. Next, I'll talk about perverse logic. Oftentimes there are very strong breakouts, but they're at support or resistance, and it's easier to make money betting that the breakouts will fail. The market is rallying strongly here, but then look at this, it reverses abruptly. Even a very strong bull trend can reverse suddenly. If this is a 5-minute chart and the market did this late in the day like this, you turn the news on, the news would say the market sold off because a certain news event happened. Remember, they believe news causes everything. They believe everything is caused by news. They have no concept of support and resistance and markets probing for fair price. News is the center of their life. They know they have millions of people watching them. They conclude that everyone believes that news controls everything. And in fact, that's silly. It's just totally wrong. Markets behave because traders are in search of a fair price. And sometimes they have to go too far to find out how far enough is. And they'll reverse abruptly. There's always news happening 24 hours a day. And if some news event happens during this abrupt reversal, TV will say the news caused the reversal, when in fact it had nothing to do with the reversal. The reversal occurred because the market raced up to test resistance and decided that there were not enough buyers there at that price, and the market had to come down quickly to find buyers. News reporters, they do not understand support and resistance, and they do not understand how markets work. Even financial reporters on financial news networks. Was this reversal down caused because of news? Well, if you turn on television, they'll say it was. If you ask me, it was due to support and resistance. We had the first leg up, and then we had a breakout and a pullback, and a measured move up is right there. When the market started to get near the target, everyone knew it would reach the target, so bears stopped selling, bulls started buying aggressively, and then once it got to the target, the bulls took profits, and the bears decided, okay, it's at a good price to sell. And both bulls and bears selling, the market reversed down. Look to the left. This strong rally tested the top of the sell climax and tested near the top of what could be a trading range. Another reason for the market to reverse down. The market's constantly trying to find the best price, the price where most trading will take place. If the market goes up too high, not enough traders will be willing to buy. The volume will disappear. If it goes down too low, not enough traders willing to sell. So the market's constantly probing up and down and up and down, trying to find the price where most trading will take place. Once the market gets near a fair price, or what the market thinks is a fair price, the legs tend to get smaller and the bars tend to get smaller. There's a consensus that this general area is a good price to buy and a good price to sell. Eventually, there are countless variables involved in pricing, and they're all changing constantly. And at some point, the fair price is no longer fair. It's either too high or too low, and the market has to quickly move to another fair price. you get a breakout. And the market's constantly probing up and down to find the edges of the range. Here, the range converged into the apex of a triangle, and the market then broke to the downside. At some point, the market decided that the price was too high, and it had to go lower to find enough buyers to keep the trading going. I've been talking about intraday charts, but the market's probing to find the best price on all time frames. This is a monthly chart of the S&P Cash Index. It turned down from this high, and then it rallied from approximately that low and approximately a 50% pullback. And then it rallied strongly, and what happened once it got to this high? It sold off. It decided again that this is too high a price. The bulls who bought up here were very disappointed by the size of the sell-off. They were happy to have the market come back to their original price so that they could get out break even. And that's a common cause of double tops. And the opposite is true here. The bears saw this collapse. Some bears sold down here. They were very disappointed by this rally, and they were very happy to have the market come back to their price so those bears could buy back their shorts, break even. So you have bears buying and bulls buying, and the market goes up again. Fundamentals are changing constantly, and there are countless variables. Nobody knows all of the variables. And the result is the range is constantly changing. The range of a fair price is constantly changing. However, it's always reversing at some kind of support or resistance. And we had this big collapse in 2009, and look where it reversed up. If you drew a trend line across these lows, it broke right below that trend line and reversed up. Although I don't have it shown, this is the 1987 crash. It also reversed up from a trend line across those lows. The market probed down to support, also support of a prior low, and found buyers just below, and then reversed up. This is the euro versus the yen on a monthly chart. The market is probing constantly on all time frames to find what the best price is. Any time frame can be the most important time frame at any given instant. Even if you're looking at a 5-minute or a 1-minute chart, sometimes the monthly support and resistance can be important. Fundamentals are constantly changing. There are countless variables. It's impossible to know all of the variables. The result is the fair price is constantly changing as well. We have a very strong bear breakout on the monthly chart, yet the market reversed up here. Why? At the bottom of a channel, and it's a wedge channel. I could draw a trend line across the top, but this is a wedge bottom with a decent looking buy signal bar. It's also reversing up near the 2000 low. This low is also a test of the low back in 2000. Support. We're racing up strongly, very, very strongly, yet it reversed down sharply. Was that due to some news report? No, of course not. It does not matter what time frame this is. It could be a 1-minute chart, it could be a weekly chart or a monthly chart. The market raced up strongly and reversed down because of technical factors, not because of news. There's always news taking place all of the time, and news is one of many, many variables. But a more important variable is support and resistance. But you have to be able to find the support and resistance to anticipate a reversal. The bulls had a weak rally here. It looks like a bear flag, first leg up. And then we got this very strong second leg up. And a lot of the bulls thought, hey, this is the start of a breakout into a bull trend. So we get a bull breakout, a pullback, and then a channel, and much higher prices. However, whenever the market has a lot of trading range price action like this, it frequently has a very strong second leg, making traders believe that the trading range is ending and the market is converting into a breakout and then a strong bull trend. A second leg trap is a second leg in a trading range or a broad channel that reverses instead of having an additional leg up. A lot of traders look at this and say, wow, that's so strong, chances are the first reversal down will fail and we'll get one more leg up. But second leg traps, no. You get a strong breakout and then an abrupt reversal. 2 legs down, 1 pullback 2. Second leg stronger than the first. It trapped traders. 2 legs up, 1 pullback 2. It reversed down. Strong second leg, testing the top of a trading range. Strong second leg up, it looks like it might break out and instead reverse down. This bar closed above the high of this bar. It looks like it might even have closed above the high of the past 20 bars. Traders are thinking, we're going to break out and we'll have a bull trend. No, it's a second leg trap in a trading range. 2 legs down, 1 pullback 2. The second leg very, very strong, closed below the low of the past 30 or 40 bars. It looks like it should be the start of a bear trend. Traders are expecting a second leg down from here after the breakout. Instead, they get a reversal up. Why is that? Because it's still probably part of the trading range. 2 legs down, second leg looks strong enough for the start of a trend, yet it reverses. Remember my 80% rule? 80% of breakout attempts of trading ranges fail. They reverse. First leg up, extremely strong second leg up, close above the high of the past 40 or 50 bars, yet look at the follow through, a big bear reversal bar. It trapped bulls into buying high, expecting this to be the start of a bull trend. 80% of breakout attempts fail. The market is always constantly drawn to magnets, support and resistance, and just like with any other magnet, the closer it gets, the faster it moves. Magnets, support and resistance. I use the term magnet to mean support and resistance. There are many types. Trend lines, measured moves, prior high, prior low. A trend line drawn across here, reverse down at a trend line. Trend line drawn across here, reverses down. A trend channel line at the bottom of a bull flag, broke below it, reversed up. Same here. Trend line drawn across these highs, it reversed down. Prior highs and lows. The market tested this high, reversed down. Tested this high, reversed down. Tested this low, the bears bought back their shorts, the bulls bought. Tested this low, the bears bought back their shorts, the bulls bought, and the market reversed up. Measured move targets. We reversed up here, went up for a measured move. We have a trading range, we broke to the downside, reversed up from around a measured move. We have a gap. This high, that low, possible measuring gap. Well, it turned out to be a measuring gap. Once the market gets close to the top or the bottom of the trading range, it's within the gravitational field of the edge of the range. And it usually cannot escape that gravitational pull until it hits the target. And then the magnet suddenly gets turned off. And like with any magnet, the closer it gets, the stronger the magnetic pull and the faster the market moves. Races down to the bottom of the range, reverses up. Races down below support, reverses up. Races up strongly to resistance, reverses down. Incredibly strong move up, but simply a magnetic pull up to support of the prior high, and then it reversed down. Once the market reaches the magnet, the support or the resistance, the magnetism disappears, and the market usually reverses and tests the opposite support or resistance. The market deciding that it's gone too far down and needs to probe up. The market's deciding it's gone too far up, it has to probe down. It's constantly searching for the best price, and it usually has to go too far to determine how far enough is. When there's a reversal, there's usually more than one type of support or resistance operating on the market. Here we have an expanding triangle at the bottom and at the top, and a breakout above a prior high, and breakout below a prior low. usually measured move targets as well. Take a look right here, this blue box, right above support. Both the bulls and the bears see the bottom and they know it's support. So what takes place? As the market's falling, everyone knows the market's probably going to get to support, maybe a little bit lower. So what will the institutions do? If you're a bullish institution, do you want to be buying here when you know it's going to get here or lower? No, the bulls stop buying. If you're a bearish algorithm, like a high-frequency trading firm, and you see the market falling quickly with a magnet just below, you're going to sell. So you get bears selling and bulls not buying, and what's the result? The market has to go lower to find buyers. The bears expect the market to get down to support, maybe below, so why would they buy back their shorts here? They know it's going to go lower, so they wait to buy. The bears are not buying, the bulls are not buying, and the bears are selling, and the result is an imbalance, and the market quickly gets down to support. With both bulls and bears believing the market's going a little bit lower, it doesn't make sense for either the bulls or the bears to buy here, so nobody's buying, and the market quickly gets down to support. The result often is one or two very big trend bars breaking through support, so it's getting vacuumed down to support. It's getting sucked down below support. But then what happens? Look at this. The market suddenly reverses. Now, why would that be? We're down to support, and the bulls decide this is a good price to buy. The market bought at this price here and at this price here. We're in that general area now. So the bulls suddenly appear and start buying again. The bears also know the market reversed up here and reversed up here and here. And they buy as well. They're buying to take profits, and the bulls are buying to put on long positions, betting that support will hold. The market usually falls a little bit below support when the market's in a trading range, and then reverses. And the opposite takes place at the top of a trading range. Right below a prior high, the market's going up quickly, and here. Do you think the bears are going to start selling here? No, they believe it's going to get up to that high, so the bears stop selling. There's an absence of bears, and the bulls now see a lot of momentum up. They know there's a high probability that the market's going higher. They buy even more aggressively. So you have bulls buying aggressively and bears not selling at all, and the result is you get a very strong move up to resistance. There's no one left to sell right below resistance because both bulls and bears believe the market's going to go up at least to resistance and maybe a little bit higher. Bears are not going to sell here when they know they can sell here. Bears stop selling until it gets above resistance, and then they sell. They sell heavily and relentlessly, especially once they see the market starting to turn down. They're confident that this is the temporary high. And the bulls expect the same. They see the same thing. They see it's at the top of a trading range, and they see a gift, a very big, sudden, high price. What a great opportunity to take profits. So the bulls sell as well. So you have bulls and bears both selling once the market goes up into the sell zone around the area of a prior high or any other kind of resistance. And you get an abrupt reversal. A beginner does not understand what's going on, and all he sees is this bar. Wow, what a big bar. Big bull bar. This is going to be the start of a bull trend. He ignores all of this to the left, and he ignores all the resistance. All he sees is that big bar, and he's going to buy up here, betting on a successful bull breakout. And then a few minutes later, he sees this and thinks, oh my gosh, that's not fair. How did that happen? But it happens all the time. Beginners are always selling low, betting on a successful bear breakout. And beginners are also always buying high, betting on successful bull breakouts. They're always expecting these strong bars to be followed by a second leg. But in a trading range, this is the second leg, and they get trapped. So leg one, pull back leg two, and then no more additional legs. The market just reverses. it gets vacuumed up to resistance, it gets vacuumed down to support, and then everybody buys bulls and bears, everyone sells bulls and bears, and you get a reversal instead of a successful breakout. Another reason why beginners buy up here is they think that it could be a huge bull trend. Yet they see all of these reversals. They're afraid that this might reverse as well, and they want as minimum risk as possible. So they're buying as soon as they are convinced the breakout is underway. They don't wait for follow-through. They want to enter early. And the same down here. They see it breaking out, and they want to reduce risk. They're afraid of losing their account. They usually have a small account size, so they sell, hoping that this is the start of a huge breakout. But they totally ignore probability. Look to the left. How likely is it that a bull breakout is going to succeed? How likely is it that a bear breakout is going to succeed? And that's one of the problems with beginners. All they see is risk, and they want to reduce risk, so they want to enter as early as possible, even if the probability of making money is very small. The beginner sells this little pullback, thinking it's a bear flag, expecting a second leg down, and this is the entire second leg, just a little bit down, does not even go below the prior low. The beginner buys this very strong bull close, or maybe he'll buy here, hoping for a second leg up, thinking that this is so strong, the market certainly has to have higher prices. And the beginner cannot believe that the pullback just keeps growing and growing and growing. He sells here, a pullback, well, maybe it'll turn down again, a low 2, low 1, low 2, and instead it keeps going up and up and up. He buys here, expecting a second leg up after the strong breakout, and then he starts to see it pull back, and the pullback just keeps growing and growing and growing, and he ends up selling down here at the bottom of a trading range. And the beginner who sold here probably buys back here at the top of the trading range. He ends up selling low and buying high. Selling low both to put on a short and to sell out of losing longs. And up here, he's buying high, either to buy back his losing short or to buy hoping for a successful breakout. In either case, he's doing the exact opposite of what professionals are doing. He'll get out of his shorts up here if he sold here. If he bought here, he'll get out of his longs down here. He's getting out of his shorts exactly where the professionals are selling. He's getting out of his longs exactly where the professionals are buying. He's doing the exact opposite of what a trading range tells you what you should be doing. In a trading range, you want to buy low, not sell low. You want to sell high, not buy high. The market just repeatedly gets vacuumed down to the bottom and vacuumed up to the top. And then it repeats the process in the opposite direction. Experienced traders understand that when the market's in a trading range, you got to be thinking of opposite logic, perverse logic. You have to bet breakouts will fail. This is unlike in a trend where you assume breakouts will succeed. Is this a trend or is this a trading range? It's clearly a trading range. I think this is true, what I'm about to say, although I have no proof of it. If I were writing computer algorithms, this is what I would do. If I'm a bearish firm, I want to sell high, but I want to convince traders that the market's going to go a lot higher so that I'll have a lot of bulls getting along at the top. I believe some bear firms who are looking to sell will buy here for a scalp, trying to get the momentum strongly up, and then they'll quickly sell once they've trapped other firms into buying too high. And that's part of the reason why we get a buy climax. They buy as it's going up, hoping to get it as overbought as possible, expecting a very sharp reversal down. And the opposite is true at the low. I think some bullish firms are selling here, trying to get it as oversold as possible, and then they quickly buy back their shorts once they trap a lot of other institutions into selling low, and then they get long as well. bears buying just below the top to make bulls believe the breakout will succeed. They want to trap bulls into buying too high, and then the bulls will have to sell with a loss on the reversal down. I don't know how important this is. I do think it was much more important 20 or 30 years ago, but I do think it's a component of what takes place at reversals. These effects like this, bulls selling at the top, bears buying at the bottom, it's mostly computers. Traders are not fast enough to make these decisions and to carry out those trades and then do an opposite trade. And again, I don't know how important it is, but I do think it's one of the factors that creates these climaxes. Again, as the market's going down to support, part of this is probably due to perverse logic. You have bull firms wanting the market to get as oversold as it possibly can be, expecting a very big reversal. So some bull firms are probably selling, expecting to buy back quickly and buy heavily and create a big reversal up. The bulls benefit by having the sell climax be as extreme as possible because it increases the probability of a reversal and it increases the probability that the reversal will be big. They want to do whatever they can to make the market be as extremely oversold as possible, and that includes some firms selling, expecting a strong reversal, and then planning on buying heavily on the reversal up. These bulls are selling, trying to accelerate the market downward, trying to entice as many bears into selling as possible. They want the bears to bet on a breakout. These bull firms are doing it because they're confident that there'll be enough buying either from them or from other firms to create a reversal and end the bear breakout. They want to trap the bears into selling too low, and then those bears will have to buy back with a loss once the reversal up begins, here and then here. Breakout attempt looks strong, but it fails. No follow-through, you get a reversal. Bull breakout attempt looks strong, but look at the follow-through, a big bear reversal bar. The trap bears exit with a loss, and they'll probably not sell again until much higher. And up here, the trap bulls are exiting with a loss, and they're not going to buy again until the market is much lower. At the bottom, strong bulls buy back their shorts, and they reverse to long. These bulls will be buying from bears who are expecting follow-through selling and a measured move down. These bears sold, expected a measuring gap and a measured move down. They're selling, and the bulls are buying from them. And eventually those bears give up. And if they are able to create a strong reversal up, a lot of times they'll be able to reverse all the way up to the top of the trading range, which they did here. And remember, the bulls want the market to be as oversold and climactic as possible, and they want to create as big a bear bar as possible to trap as many bears as possible, and that increases the chances that you'll get a very strong snap back, a very strong climactic reversal up. They're trying to encourage bears into selling low. They want the bears to believe there'll be a breakout and a measured move down. And then they trap the bears, and the bears have to give up, and they exit with a loss, and they'll probably not sell again until the market gets much higher. On the way up, the bulls are trying to prevent pullbacks. They want to force the bears into buying back as high as possible. When this is starting to go up, there are some bears who are still short. The bulls are buying aggressively, trying to prevent a pullback to make the bears have to buy back at a very high price. And that high price will be where the bulls will be selling, taking profits. At the top, you have bears that are buying, trying to create as extreme a buy climax as possible to increase the chances that the reversal down will be very abrupt and go very far. Once it gets to their sell zone, they sell out of their longs and they reverse to short. And they'll be selling to bulls who see the strong breakout and who are hoping it's the start of a strong bull trend. They're expecting a measured move up, maybe based upon the height of the trading range. And instead, the market starts to reverse down quickly, and those bulls are trapped and they have to sell out at a loss. These bears that are buying with the intention of creating a buy climax are going to sell strong enough to reverse the market down. One firm alone cannot do it, but if enough firms are doing this, confident that the market will stay within the trading range, you do get the reversal down. And as I said, when you have a trading range and you get a breakout attempt, 80% of the time the breakout will fail and the market will reverse. And that's true even when the breakout is strong like this or like this, it's still probably going to fail. Most firms expect it, and once the market gets high enough, a lot of firms will start to sell, overwhelming the bulls who are buying, hoping for a successful breakout. The bears at the top, they want to sell as high as possible. They want the market as overbought as possible because that has a better chance of creating a big reversal down. The bears want a big bull bar. They're expecting the market to fail on its breakout attempt, but they want it to be as strong a bull bar as possible to trap as many bulls as possible into buying high, because then those bulls will have to sell, and that will add to the selling and lower prices. Those trapped bulls who bought here and who sold here with a loss, do you think they're going to buy again right here? No. The reversal, big like that, there's going to be at least a second leg down before the bulls will buy again. And that reduces the chance of any rally, and it increases the probability that the bears will make a bigger profit. The bears who sold up here or up here, they want to sell aggressively and strongly. They want to drive the market down very far so that there will not be a pullback until the market has gone a long way. They want to force the bulls into selling out of their longs at a very low price. That increases the chances that the bulls will not buy again for at least many more bars, and increases the chances that there will be lower prices. So if the bears can make the sell-off drop very, very far before there's a pullback, chances are the bulls will sell out of their longs with a loss and not buy again. And the bears who did not sell initially are eager to sell, even at a low price like this, and they'll sell. Bulls and bears selling, the result is a second leg down. It's an advantage for the institutions that sell up here to drive it down as far and fast as possible, because that increases the chances that you'll have trapped bulls who have to sell, and you have bears who are trapped out and who are eager to sell. And the first reversal up will fail, and you'll get a second leg down. I began by talking about the vacuum effect. When the market approaches support and resistance, it often accelerates, and then once it reaches the support or resistance or goes a little bit beyond it, it then reverses. And then I talked some about perverse logic, that there are some bull firms who are selling near the low of a trading range, trying to create as big a sell climax as possible, and then they buy. And then near the top, you have bear firms buying near the top, trying to make the market as overbought as possible, resulting in as dramatic a buy climax as possible, and then they sell and ride the trend down. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 6 videos on trading ranges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th and final video on trading ranges. When the market's in a trading range, remember my 80% rule. Do not bet on breakouts because 80% of breakout attempts will fail. However, all trading ranges eventually successfully break out into a trend, and I'll discuss that next. And every trend eventually evolves into a trading range, and I'll talk about the early signs of a trading range. When the market's in a trading range, it does not spend much time at the top or at the bottom. It usually reverses back toward the middle of the range, and most of the trading takes place in the middle of the range. Prices keep getting pulled back to the middle. And in general, that's a bad area to be trading. It's much better to be looking for bear breakout attempts, expect them to fail, and buy a reversal up at the bottom. Bear breakout attempt, micro double bottom, buy a reversal up at the bottom, expecting the market to rally at least enough up for a scalp. And traders should look to sell reversals down at the top. Couple legs up, one pullback two. This is a little bit tricky. The reversal is so climactic and so extreme, bulls are probably trapped and eager to get out. This is an instance when you probably can sell in the middle of the range, expecting the market to fall at least far enough down for a scalp. One of the important things to realize in a trading range is you make more money by scalping. Because if you don't get out, the market usually comes back to your entry price. If you buy here and do not take your profit somewhere up here, guess what? The market comes all the way back to your entry price. And the same with up here. If you sell here and do not take profit when you have it, the market comes back to your entry price, and then you have to decide what to do. Some traders like to sell with limit orders. For example, sell a strong bull close near the top, or buy a strong bear close near the bottom. And again, when the market comes down to the middle of the range, take profits. Traders expect breakout attempts to fail and for the market to get back to the middle of the range. Bull breakout, bear breakout, bull breakout, bear breakout, bear breakout. So traders fade breakouts. And by fading, what I mean is you bet the breakout will fail. So if you get a bull breakout, to fade it means to sell it. If you get a bear breakout, to fade it means to buy it. Trading ranges are constantly trying to break out. Every one of these bull bars, every one of these bars with tails on top is an attempt to break to the upside. Every one of these bars with tails on the bottom, the bear bars, are all attempts to break to the downside. And my 80% rule, 80% of trading range breakout attempts fail. Therefore, you stand to make more money betting on a failed breakout instead of betting that a breakout would be successful. It's bad to buy near the top. You have a decent looking bull bar, micro double bottom, maybe that's an okay buy. If you take it and it goes up twice here and reverses down, you get out here with a loss. Here, this is a terrible buy. It might be a successful bull breakout, but it's better to wait to see if there's a second follow-through bar. When you see the follow-through bar looking like this and you bought here, you know you're going to lose money. Opposite's true, selling near the bottom. We got a bear breakout here, but a big tail. Terrible follow-through bar. For the bears, some bears will look at this as a pullback from this breakout, and maybe they'll sell below that bar. I would not do that. You're selling a bear flag at the bottom of a trading range with a bad looking sell signal bar. So selling that close or selling below this bull bar, it's a losing strategy. Instead, you should be doing the opposite. You should buy low, sell high, and scalp. BLSHS. Bet that the breakouts will fail. So you see a bear breakout, an experienced trader will buy that bear close, betting it will fail. Here you get a reversal up, second reversal up, one pullback two, a high two buy. Buying near the bottom, that is a reasonable buy. A reversal down, two legs up, one pullback two legs up, one pullback two. Sell the close. if you don't want to be selling below the low of the bar or below the low of this bar in case that reversal bar is big. A lot of traders will simply sell the close thinking that, well, the bulls need one more bar. Chances are they will not get it, so I'll sell that close betting that the next bar will be a bear bar. The same with right here. You could sell that close betting that the bulls need at least one more bar. They probably will not get it, so just sell that close. Or you can sell the reversal down below that bear bar. All trading ranges eventually break into trends. The market's in a trading range, and then we have a couple very big bull bars closing far above the highs of the past 40, 50, 60 bars. Every trading range always leads to a successful breakout. You have a better chance of a profit if you wait to see a strong breakout. Now, what do I mean by a strong breakout? Well, it's good to have a very big breakout bar. It's good to have follow-through on the next bar or the next 2, 3, or 4 bars. Consecutive big bull trend bars increase the chances of a successful breakout. No tails or small tails on the tops of the bars. The close of this bar above the high of many bars. Here, this close is above the high of the past 50 or 60 bars. Here we have a trading range. Breakout mode, 50% chance bull breakout, 50% chance bear breakout. Sometimes a trading range simply bends into a trend without ever having a strong breakout. For the bears, they're hoping for a bear breakout, a lower high, and another bear breakout, and a series of lower highs and lower lows. And the bulls are hoping that we're getting higher high, higher high, higher low compared to that low, and they're hoping that that will continue up, and they'll get a broad bull channel. Well, the bulls won. We have a little bit of a breakout here, but still within the range, and now we have a breakout with follow-through, probably going higher, but not an impressive breakout. Every reversal attempt, the bulls kept buying, so the reversals were small, and the bull channel was tight, and the result was a bull trend without ever having a very impressive, strong bull breakout. A little breakout here, a little bit more here, but it still resulted in a bull trend. Trading range, we got lower highs and higher lows. Breakout mode. Traders are always looking for some imbalance between the bulls and bears prior to the breakout to get some idea of the direction of the breakout. And it often allows traders to enter swing trades before the breakout takes place. Is there anything going on here that would increase the chances of a bull breakout or a bear breakout? We have 5 consecutive bear bars and 6 consecutive bear bars here. We got some lower highs and lower lows. Look at the consecutive bull bars. We have 2 consecutive bull bars here. We have 2 here, 2 here. The bears are owning more bars in a row. Well, that's selling pressure. Even though this is a bull trend and a pullback, and the pullback grew into a trading range, the bears are starting to own more bars, more consecutive bars, 3 more bars here. So that's an early sign of bears being stronger than bulls. And then we have lower highs here, 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 and lower lows. Yes, we still have higher low here, and we still are following a bull trend, but there are early signs that the bears might be winning. And ultimately, the bears did win. Never had a strong breakout, but it did have a bear breakout, and it worked lower. Strong reversal up, but not much bull strength. Bad follow through after this bull bar, after this bull bar. Parabolic wedge, 1, 2, 3. Probably going to go sideways. Initially, this was a pullback, but once it reaches 10, 20, 30 bars, I call it a trading range. By pullback, I assume the market's going to resume up. But when it fails to resume up for 10, 20, or 30 bars, I call it a trading range. And by trading range, I mean the probability of a bull breakout, trend resumption up, has fallen to the same as the probability of a bear breakout, trend reversal down. Again, look at the bear legs, consecutive bear bars, more bear bars closing in their lows, and compare it to the bull legs. Where are the consecutive big bull trend bars? The bears are starting to own the market for more bars at a time, a sign of strong bears. 2 consecutive bull bars, a doji, but 2 consecutive bull bars, followed by 3 stronger bear bars. We have a bear trend and then a pullback, and the pullback grew to 20 or more bars, so a trading range. 50% chance we'll get a successful bull breakout or trend reversal. 50% chance we'll get a successful trend resumption down. Also, whenever the market's in a tight trading range, it's in breakout mode, 50% chance the first breakout will fail. Here, we're trying to break to the downside, and it reversed up. Traders look at every breakout as a possible reversal, and they expect then a possible breakout in the opposite direction. The bears have 3 consecutive bear bars, close maybe slightly below this low and all of these lows, so it's a breakout, but reversed up. So whenever you see a breakout, be prepared for a breakout and a trend in the opposite direction. It could happen here as well. We have a bull breakout and it could fail and we could reverse down into a bear trend. However, the bears had a pretty good chance here, and the bulls reversed up, and then they have a pretty good bull bar here. And it was followed by a bull trend. Look what took place here. After that bear breakout attempt, we have 9 bars here and only 1 bear bar in the past 9 bars. The bears are losing control. It's not a lot of strong bull bars, but it's only 1 bear bar out of 9 bars. So the bulls are owning a lot of bars. This close, a big bull bar. In fact, it's the biggest trend bar up or down in the past 40 or 50 bars. And it closed not only above the trading range, but far above the trading range. That increases the chances that it will be successful. Yes, the bears tried to reverse it. They tried to make it a failed breakout, but the bulls got a breakout test by here, a breakout test of this high. In fact, there's probably a little gap between this high and that low, and a good buy signal bar. They get a breakout above this bull flag, and then a pullback here, and then another breakout. Bull flag by the breakout above the bull bar, and you can call this a bigger bull flag or simply a breakout of this bull flag and a pullback from this breakout. So this becomes a small bull flag and this small bull trend. All trends, all channels eventually become trading ranges, and I want to talk a little bit about the early signs of a transition into a trading range. This is a 5-minute chart of the euro versus the dollar forex market, and the start of the US session, it's never exact, but it's around 5:30 in the morning Pacific time. I always pay attention to the first 5 or 10 bars to see what they look like. What does this look like? We have a couple bull bars, but then a bear bar, a bull bar, then a doji, and then bear bars, and then a reversal up. Plus, look to the left, a lot of trading range price action, an absence of strong consecutive bars up or down. We have a couple big bull bars here, but a reversal down. Bear bar here, but a doji. Bear bar here, but a doji. This looks like a bear leg and what will become a trading range. This looks like a bull leg and what will become a trading range. Trading range price action on the open, and even though overnight it sold off, the sell-off had a lot of trading range price action, meaning that this bear channel probably is soon going to evolve into a trading range. The odds are the market's going to have trading range price action for at least an hour or 2 or 3 on the open today. And it did. strong bull breakout, bad follow through, another attempt to break out, bad follow through. And these first few bars were a warning that today would have a lot of trading range price action, especially in the context of a weak sell-off like this, which looks like a bear leg and a trading range. Bear channel, bear trend, but probably it will evolve into a trading range, which it did. When you're over here looking back, you'd say that this is part of the trading range, even though if you're at this point, you think you're in a bear trend. It's a bear trend, yes, but probably a bear leg and what will evolve into a trading range. Is this the first bar of the day session? Maybe. If it is, it's a doji. Very prominent tails on all of the bars here. A lot of overlapping bars. The bars almost completely overlap. A lot of reversals up and down and up and down and up and down. That's all trading range price action, and it increases the chances that the market will have a lot of trading range price action for the first couple of hours, and it increases the chances that the entire day will have a lot of trading range price action. Bear bar and bull bars. Bull bars, then bear bars. Bad follow through, lots of reversals. 5 or more reversals in the first hour or two. Many bull bars, many bear bars, lots of reversals of directions, trading range price action. I don't have a moving average shown here, but the moving average would be pretty flat. That's another sign that the market is not trending. No gap on the open. Forex markets don't typically have gaps, but futures markets and stock markets often have gaps. And that absence of gaps and then this trading range price action all adds to the increased probability that the day will have a lot of trading range trading. With all of these reversals and the bad follow through, it's easier to make money with limit orders selling above bars, betting breakouts will fail, buying below bars, betting bear breakouts will fail, than it is to enter with stops and make money. Stop orders are less successful than limit orders. That's another sign of a trading range day. I call it a limit order market. When it's easier to make money with limit orders than with stop orders, the market's probably going to be in a trading range. And then the prior session was a trading range, or it had a lot of trading range price action. This part of it is a bear trend, but it's mostly a trading range. It looks more like a broad bear channel with lots of reversals, basically a trading range that sloped somewhat down. If you're looking at a chart and you're feeling confused, for example, by all of the reversals, or if you're feeling anxious, that's your personal radar telling you that the market's probably in a trading range. So get peaceful and trade it like a trading range. Don't worry about trading it like a trend. It's not a trend, and it's probably not going to trend. A trading range day usually reverses and tests the middle of the range repeatedly. Later in the day, if it tries to break free of the open of the day, it usually comes back and tests the open. And it usually ends up closing around the open of the day. If the open of the day is in the middle third of the day's range, the day usually tends to close near the open. Sometimes it can turn into a bull trend at the end or bear trend at the end, but most of the time when you have repeated reversals around the open of the day and the open is in the middle third of the range, the day will close around the middle third of the range as well, and the bar will end up as a doji bar on the daily chart. Trying to break free and become a trend at the end of the day, but the breakout is not all that strong. Chances are we're going to come back and test the open. The session began as a tight trading range. The range for the entire session was fairly tight, and it ended up closing right around where the session started. I talk more about the behavior at the end of a trading range day in the video on trading the end of the day. I began by talking about when you see a trading range, don't bet on a breakout. If anything, bet the breakouts will fail and look to fade the range. Look to sell at the top and buy at the bottom, betting that the breakouts will fail. All trading ranges eventually break into trends, and sometimes there are signs that give a clue to the direction of the breakout, and you should look at those as the trading range is forming. And finally, early in every day, early in every session in the Forex markets, there are signs that can tell you that the day is likely to become a trading range day. If you see lots of reversals, lots of overlapping bars, very prominent tails on the first few bars of the day, that's often a sign that the entire day is going to be mostly a trading range day. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 6 videos on trading ranges.